Good morning, friends. In the previous class, we started discussing about the concept of Markowitz portfolio theory. Today, we will complete this slot, Markowitz theory. We will also discuss about the concept of capital allocation line as well as capital market line, and then move on to the next area called as capital asset pricing model. At least we'll try to have the introduction to CA-PM in today's class. Let us summarize what is discussed in this chapter till now before we continue with the Markowitz portfolio theory. So we began the chapter by saying that to value an asset, we require a discount rate. Discount rate in turn depends upon the risk of the asset that is being valued. So the main aim of this chapter is to discover discount rate for asset valuation is the main objective of this chapter, portfolio management. And in that pursuit, we'll also see how investment should be made, how investments are should be made to the maximum satisfaction. So here there are two questions that are sought to be answered. Number one, how to measure a risk, how the risk should be measured, and for taking a given level of risk, what should be the return one should be expecting or requiring, are the two main questions we try to answer through this chapter, portfolio theory. So here we divided the chapter into 5 segments, namely risk return profile, which discuss about the basics in the portfolio management. Segment number 2 is Markowitz portfolio theory. Capital asset pricing model is the third one. Sharp single index model is segment 4. And the last segment is arbitrage pricing theory. Apart from these 5 segments, we discuss one area called as efficient market hypothesis, where we have a debate whether the market is efficient or inefficient. Based on that discussion only, whether this theories will be holding true or false also depends upon it. It is called as efficient market hypothesis. These are all the areas we target to cover in this chapter, portfolio management, in which we fully completed the first slot, namely the risk return profile. Number 1, when we analyze a security, about the security we should know only about two things. What is the expected return from it and what is the risk of that particular return. Any other asset analysis will be much more higher. When you pay a price for the security, when you pay a price for a share, or when you pay a price for a bond, all financial instruments, the simple thing is, I have only two features to look for it. One is what return it is going to give me. Number 2 is how certain is the return. But like this, we cannot say for any other asset. Suppose you want to compare two TVs. Okay, can I buy this brand television or other brand? In that case, there are so many features you compare. So what is the picture quality, what is the screen size, etc. It becomes comparison very difficult, right or not? But when you compare two financial assets, very simple. Investment in financial is very simple because I have to compare only two things. What are the returns that are expected from the assets and what is the risk of that particular return. That is what we call as a security analysis. Return expected from a security will not be the extreme returns, will be the average return. So the average can be a simple average if you rely on the historical data, or can be a weighted average if you do a scenario analysis. And the risk of a security is a standard deviation. Standard deviation of x is equal to square root of sigma x minus x bar the whole square divided by n. And if you have been given probability, in that case square root of sigma p into x minus x bar the whole square is the calculation of standard deviation. More the standard deviation, more the return varies, more at risk. Lesser the standard deviation, lesser the variability in returns, lesser the risk. Standard deviation 0 means no risk at all because the return does not vary from the mean. This is regarding the risk and return of an individual security. But I need not invest only in one security. I can invest in combination of securities. Then I am said to be holding a portfolio. How a single security can have a expected return as well as a risk. The portfolio too can be having an expected return as well as the risk. So the return of a portfolio is computed using the simple concept, weighted average return of the individual securities, where we have the following column: securities, the return, proportions, and then weighted return. But the risk of a portfolio is not equal to the weighted average risk of the individual security. It is something different. We calculate using the following formula for a two security portfolio. Sigma P is equal to square root of W1 square sigma X square plus W2 square sigma Y square plus 2 into W1 into W2 into sigma X into sigma Y into correlation of X and Y. Portfolio risk is influenced by three factors. Number one is what? Individual security risk. Number two is the proportion. Number three is co-movement. Individual security risk measured by sigma X, sigma Y, proportion by W1, W2, co-movement by correlation coefficient or XY. Correlation can take values from what to what? -1 to +1. -1 is perfect negative. -1 to 0, negative. 0, no correlation. 0 to 1, positive. +1 is perfect positive. And the correlation is perfect negative, maximum risk reduction can be obtained. When correlation is +1, risk reduction cannot be obtained. In between, the risk reduction reduces as a correlation tend towards +1 is what we have discussed. When R is equal to +1, then sigma P is equal to W1 sigma X plus W2 sigma Y. When R is equal to -1, sigma P is equal to W1 sigma X minus W2 sigma Y. Then we saw when R is equal to -1, through an optimum proportion, even the risk can be reduced to 0. Proportion of X is equal to sigma Y by sigma X plus sigma Y. Proportion of Y is equal to sigma X by sigma X plus sigma Y. We also learned in the last class how to calculate the correlation. Correlation of X and Y is equal to covariance of X and Y divided by sigma X into sigma Y. Covariance of X and Y without probability is sigma X minus X bar into Y minus Y bar divided by N. With probability is sigma X minus P into X minus X bar into Y minus Y bar. Then we saw that the sigma P standard deviation of portfolio can also be given by the formula W1 square sigma X square plus W2 square sigma Y square plus 2 into W1 into W2 into covariance of X and Y is yet another formula. Then we discuss about the three security portfolio standard deviation. Sigma P for a three security is W1 square sigma X square plus W2 square sigma Y square plus W3 square sigma Z square plus 2 W1 W2 sigma X sigma Y correlation of X and Y plus 2 W1 W3 sigma X sigma Z correlation of X and Z plus 2 W2 W3 sigma Y sigma Z correlation of Y and Z square root gives you the standard deviation. We generalize it for a n security portfolio like this. We will be having n square terms, in which n will be the variance term, n into n minus 1 will be the covariance term. As we diversify more and more, the individual security risk becomes irrelevant. How they meet together becomes what? Very much relevant. The covariance term becomes significant compared to the variance term is what we discussed in the first stage, that is basic risk return profile. Everybody, are you following or not? Now, then we started discussing about the next concept called as Markowitz portfolio theory. Can I proceed with that or not? Now, let me summarize what has been done till now in Markowitz theory and then go for the next stage. Okay, now. See, we started discussing about Markowitz theory using question number A. Before that, is sound audible or not? Is that clarity or not? Yes or no? Okay. Okay, now. So in question number A, we looked at a portfolio consisting of two securities. Please, now all of you listen. Today's discussion is going to be a very continuous one where we are not going to do too many problems today, but we are going to have so many discussions in today's class. So probably you should be prepared for that. It will be a little bit heavy, the discussion. But once we cross the CAPM introduction, then we can just start doing problems in a very fast manner. But till we cross the CAPM, it will be a little bit a lengthy discussion we are going to make in today's class. Can I start or not? Now, all this discussion which I make only will help you to understand the portfolio theories much more better. Otherwise, you won't be able to figure out in the examination whether they are asking a question on CAL or CML or a SML or another CML or two CML, capital market line, characteristic market line, capital allocation line, security market line. All are going to discuss only about KE calculations in different manner. You won't be able to figure out what they are asking you in the examination unless you have a very detailed discussion about each and every aspect. So, little bit higher level only will be having the discussion, but not difficult. One should be patiently listening what is being discussed. Always understand that the subject is not solving problem and copying and going home. It's all about learning how the things are actually working. Can I start or not? Now, in that, we started with question number 8. We had two securities. Can you name the two securities? Security A and then security B. Now, security A gives you how much return? Everybody participate. How much return? 12%. Security A has a risk of 20%. Security B gives a return of 20%. Has a risk of 40%. Can I proceed? Now, the correlation between A and B is minus 0.2. This is all the detail which has been given. Okay. Now, I constructed 6 portfolios. We can even construct 60 portfolios with A and B in different combinations. For a sample, I constructed how many portfolios? 6 portfolios. First portfolio consists of A fully, no B. Second portfolio, 90% A, 10% B. Third portfolio, it is 75.9% A and 24.1% B. Like that, fourth, fifth, and then sixth. For all these portfolios, we found out the portfolio return as well as what? Risk. Tell me what is the return of the portfolio? Weighted average return of the individual securities, where the weights are the proportion of A and proportion B. And the risk of the portfolio sigma P is given by the formula W1 square sigma A square plus W2 square sigma B square plus 2 into W1 into W2 into sigma A into sigma B into correlation of A and B is what we had as the risk of the portfolio. For the different portfolios, we found out the risk as well as what? Return. Okay. Can I proceed further? Now, see, what is the nature of security A? I want an answer. What is the nature of security A? Low risk, low return. What is the nature of security B? High risk, high return. In a portfolio consisting of a share which is having low risk, low return, if I inject another security, having high return as well as what? High risk, the portfolio return increases. In a high return security coming in means the portfolio return increases. At the same time, the portfolio risk also is expected to increase. Does it increase or not? No. To our surprise, introducing B increased the return but did not increase the risk. In fact, it has begun to decrease the risk. So when I injected B, the 12 became what? 12.8. The 20 risk became what? 17.64. Why this was happening? This was happening due to the diversification or the negative correlation we had between A and B. Diversification reduces risk. We discussed in the first slide or not. So due to which, when a risky security is introduced, return increases. At the same time, risk is also what? Decreasing. Is this diversification benefit happening forever up? No. After some time, that is after portfolio 3, from portfolio 4 onwards, what happens? The return increases. At the same time, the risk also begins to increase. In such a case, we had a diagram like this. The diagram is, the curve first moves what? Leftwards, upwards, and then makes a right turn and moves rightwards and upwards. Everybody, yes or no? That means we can say security 1 gives you some return and risk. For security 2, portfolio 2, the return what? Increases. How you know return increases? It is moving upwards. But the risk is increasing or decreasing or decreasing. And I am moving leftwards. For the point number 3, the return further increases. The risk further decreases. Then onwards, the return what happens? Increases. But the risk also increases. Respond yes or no? Now, if this is a curve, when the correlation is minus 0.2, when the correlation is minus 1, then it will be reaching up to what? 0 before going rightwards. In that case, when R is minus 1, it goes up to 0 before it goes rightwards. When R is equal to plus 1, it will never move left, it will always move only what? Right. For higher return, have to take what? Higher risk is what we seen as the different correlations and the various curves. Everybody following or not? Now, in that case, when correlation is minus 1, through a combination, I can reduce my risk to 0. Right or not? Tell me, what is that combination? Proportion of A is equal to sigma B by sigma A plus sigma B. Proportion of B is equal to sigma A by sigma A plus sigma B. But when correlation is not minus 1, still I have a portfolio giving me the lowest risk. If not 0, this is going to be the lowest risk portfolio having A and B combination. Right or not? Tell me how to find out this. Proportion of A. Proportion of A is equal to everybody. Sigma B square minus sigma A sigma B. Correlation of A and B divided by sigma A square plus sigma B square minus 2 into sigma A into sigma B into correlation of A and B. Like the proportion of B, everything is same. Instead of sigma A square, B square, what as what? Sigma A square. Like that we found out. Respond, yes or no? Now, so this portfolio 3, which is going to have the lowest standard deviation with a combination of A and B, we call it as what portfolio? Minimum variance portfolio. Are you following or not? Now, my question is, I think we discussed efficiency frontier now. Any notes written for efficiency frontier? Okay, now let us summarize that and have the notes and then do a problem in the efficiency frontier. Okay, listen here. My question is, there is portfolio 1, 2, 3, 4, 5 and then what? 6. Answer is portfolio 1 a good portfolio or a bad portfolio? Why is it is not good? Because 2 is better than 1 as 2 gives what? More return for a lower risk. Now, is portfolio 2 a good portfolio or not a good portfolio? Not a good portfolio because the portfolio 3 is a better one because it gives what? More return for a lower risk. Now, 3 is a good portfolio or not? Yes. 4 is a good portfolio or not? Yes. Because 3, 4, 5 and 6 are not inferior to any other portfolio. If your portfolio is inferior to another portfolio, it becomes inefficient. If it is not inferior to any other portfolio, it is not inefficient. Respond yes or no. Can I proceed now? Now, in that case, 3, 4 and 5 and 6 are the 4 portfolios in this curve which are said to be what portfolios? Efficient portfolio. Right or not? Now, see what happens is, this has been already calculated in yesterday's class now. Now, I just take out the inefficient one and start writing only the efficient one. And this curve, they call us what? Efficiency frontier. They give a name Markowitz efficiency frontier. What efficiency frontier? Markowitz efficiency frontier. That means there should exist another efficiency frontier or not? We will be discussing in the capital allocation line in the next stage. Everybody follow or not? So this is called as what? Markowitz efficiency frontier. Very simple. What is Markowitz efficiency frontier? Draw the curve, that is the portfolio curves, and start from what? The minimum variance portfolio, the curve, and then go forward. That curve is called as what? Efficiency frontier. Very simple. All the points in the curve, that is below what? Minimum variance will be taken out. From the minimum variance, when I start the curve, that curve is called as what? Efficiency frontier. Respond. Are you following or not? Now, What is an efficiency frontier? Question arises, what is a efficiency frontier? Efficiency frontier is a curve which is having portfolios, which having what? Portfolios or stocks. Securities are portfolios which are all efficient, which are all what? Efficient. Tell me, I am showing a point here. Able to say arrow mark or not? This point is efficient to be a, inefficient to be a. It is same as what? The 3 or 4. Are you following what I am saying? All the points in this curve are all what points? Efficient points only. All the portfolios are securities in the efficiency frontier are all what securities? Efficient securities. Enna right or not? So what is an efficient security or what is an efficient portfolio? Efficient portfolio is a portfolio which does not have any other portfolio. Does not have what? Any other portfolio which is giving more return for a lower risk or more return for a same risk or same return for a lower risk. If there exists no other security for this, then the security is called as what? An efficient portfolio. Everybody yes or no? And all the points on this efficiency frontier are all what? Efficient portfolio. Respond. Are you following or not? Now, see, very simple. We took a 2 security share market. In a stock exchange, there are how many securities here? 2 securities, A and B. Right or not? Now, like that, a stock market can have 3 securities or what? 4 securities. Ultimately, naturally, a stock will be having something around 1000 to 1500 shares, but you need not worry about all the shares. Generally, there are popularly 50 to 100 securities in any given stock exchange. Developed countries may be having 500 good securities in the stock exchange. Respond, are you following or not? In that case, what we did for 2 securities can be done for what? N securities. Can be done for what? N securities. Very simple. How it looks like is, we have x-axis as what? Risk. Y-axis as what? Return. Okay. Now, we had 2 security A and B. We had 2 security what? A and B. The curve for A and B may be looking like this. This is A and this may be what? B. There may be another 2 security B and C. B may be low risk and C may be what? High risk. For example, the curve for B and C may be what? Looking like this. Everybody, are you following or not? So, there can be one curve which we have drawn now for what? A and B. There can be another curve we can draw for what? B and C. This is a efficiency frontier consisting of what? A and B. This may be the efficiency frontier consisting of what? A and C. Okay. I can have 3 securities A, B and C. I can have 3 securities what? A, B and C. In which the frontier may be what? Something like this. Because when I combine more securities, I'll be having what? More risk reduction. Yes or no? Like that. When I have N securities, for all N securities, there can be one frontier. Possible or not? It can be found out through the system. That is, with this very simple, I have to only find out for different combinations, the correlation, the standard deviation, then what? The say comparison. And if you know the logic for 2 securities, one can know the logic for what? N securities. Only thing is how to do it. It is very difficult to do manually is an issue, but one can do easily using system. Very simple. Yeah. A and B, what I did? I combined different proportions of what? A and B and found out the minimum variance. From there, what started? The efficiency frontier started. Like that, I can do it for A and C, different proportion. I can do it for what? A, B and C. I can do for what? A, B, C, D. I can do for what? A, B, C, D up to Z. Right now what I am saying? The way in which I calculate is what? Same only. Probably may be very much baffled by how to do such calculation. That question may arise. I don't deny that. But there is systems to what? Calculate. Software can calculate the efficiency frontier for any security. Yes or no? Very simple. What we should do in a share market, whatever securities are traded, if not all securities, at least a top 30 or what? Top 50, one can put into what system? Put their respective returns as well as what? Risk. It will get you the efficiency frontier. Are you follow what I am saying? What I want to say, understand is, it is possible to calculate what? Efficiency frontier for a entire share market. He extended with the help of a 2 security portfolio. This can be extended to what? N security portfolio. Up to this, are you convinced or not? Now, next. In the share market, there are so many shares. There are what? So many shares. I will not invest in those shares or those portfolio of shares. It may be one share or what? Portfolio. I will not invest in those stocks and those portfolio of stocks which are lying below efficiency frontier. Lying below efficiency frontier. For example, are you all able to see my arrow mark? Okay. Suppose there's a share Z. There's a share what? Z, which is give a point here. That means Z gives for this. Z gives what? For this risk, so much return. It gives what? For this risk, so much return. Tell me, is Z a good portfolio, bad portfolio? Bad portfolio, because for this risk, this 4 is giving you what? Yeah, higher return, or the 4 is giving for the same return at lower risk. Everybody, are you follow what I'm saying? So any point below the efficiency frontier is inferior to the points lying on the efficiency frontier, because for this point there is a corresponding point in the frontier that gives a higher return for the same risk, or this point that's a leftward point that gives what? Same return for a lower risk, and so on. So any share that is going to give you a risk and return, a expected return and standard deviation which is below the efficiency frontier, all those securities in the share market are called as what? Inefficient securities. Enapa accepted? Did you follow, or should I repeat? Now again I say, every step let us go one by one, but you should not just listen like listening to a story. One should listen carefully each and every word I am speaking. I am only discussing for you. Study material and all doesn't discuss all these things elaborately. Can I put or not? Not most of the Indian authors books doesn't say discuss all this what elaborately. Please, but this understanding is very important for you to comfortably answer any portfolio question or really understand the subject here. Can I start or not? Now, anybody who want me to repeat once again, raise your hand. Okay, that's good. Now I'll repeat once again. Please be open about if you want to explain. Don't allow me to go to the next stage once if you don't understand the previous discussion. Enna purinjudha? Appana or discussion I did not ask you. Now up to this diagram, have you understood? Yes, last class discuss pannalapa, yes or no? No. So this curve, did you understand or not? It went for simple. The share market has got how many securities? In the track, just follow the track, okay? Because you'll always lose track of what I'm discussing unless you come with me. Can I proceed? Now, that is a share market, Rajagopal Stock Exchange, RSC, okay? For example, okay? RSC Regional Stock Exchange or name change, that's all, okay? There are only two shares, Rajagopal Limited, Soumya Limited, yes or no? Okay. Only two shares are what? Listed trading, okay? Nobody listed in my exchange, yeah, okay? Now, there are two shares here. For example, come to a serious discussion, A and what? B. A stock exchange has got two securities, namely what? A and B. Don't think that I have only two investment opportunity. I can have infinite investment opportunity by having different combinations of A and B. Every portfolio is an investment opportunity. So no, don't invest in only invest in securities, and even invest in what? Portfolio of securities through combinations. Respond yes or no. Don't think that a combination of A and B will have the features of A and B alone. No, it is also having a feature of a correlation coefficient, right or not? In that case, I took 6 combinations. How many combinations here? 6 combinations. I can have 600 combinations inside this curve. I can even have infinite combinations inside this curve. Yes or no? 0.000001A and what? 0.999999B can be one combination. Yeah, right or not? There can be what? Infinite combination on this curve consisting of A and B. Accept or not? Now, in that first we saw that A is low risk, low return. B is what? High risk, high return. Only A, lowest risk, lowest return. But if I inject B, what happens? Return increases, risk decreases. Able to follow or not? All this happening due to what? Correlation or diversification. But this is not going to happen forward. The curve makes a right turn. Ennapa right turn? In that case, the leftmost point we give a name. What's the name for the leftmost point? Minimum variance portfolio. How to find out this minimum variance portfolio? Proportion of A is equal to that formula we had. Proportion of B is equal to that formula we had. We found a minimum variance portfolio. Yes or no? Question, sir, why should I find out minimum variance portfolio? What is so great about it? From there only efficiency frontier starts. You know, all this below minimum variance portfolio will be what? Inefficient to minimum variance portfolio, right or not? From there only what really starts here? Efficiency frontier starts. Respond yes or no. And when the correlation is -1, the minimum variance portfolio will be having what risk? 0 risk. For this combination of A and B, efficiency frontier starts here and this line becomes the efficiency frontier. Yes or no? The line below this are inefficient because it is inefficient to the minimum variance portfolio, right or not? When the correlation is +1, then all combinations are what? Efficient only. We cannot say any inefficient because everything gives you more return for more risk. Respond, or because the minimum variance portfolio is what? Each security 100%. Everybody following what I am saying? Now, this is what we discussed in the first slide. Now, so then what we did is we put the efficiency frontier. We put what frontier? Efficiency frontier. This is the efficiency frontier for what stock exchange? For Rajagopal stock exchange, consisting how many shares here? 2 shares. Consisting how many shares here? 2 shares. Now, you may wonder, sir, 2 shares you are able to easily draw it with combination of what? A and B. What happens if I have what? 3 shares? No problem. Yeah, I can have what? Combination of A and B, B and C, A and C, A, B and C. Yes or no? You see for all the combination and select what? Optimum portfolios, one can find out those numbers which gives you what? More return for more risk. Yes or no? No. Like that, one can find out for what? Even 100 security portfolio, the efficiency frontier. Able to understand my discussion or not? No. So, from this, we saw that efficiency frontier consists of securities. Yes or no? Yes, sir. It consists of what? Securities or portfolio of securities. It can be one single security or what? Portfolio of securities. All of them are what? All of them are good. Or all of them are what? Efficient. Why you say all those securities are efficient lying the efficiency frontier? Because there exists no other portfolio of security that gives you what? Higher risk for a higher return for a lower risk, or a higher return for a same risk, or a same return for a lower risk. This is what we call as an efficient portfolio. Respond. Are you following? Yes, sir. Now, very simple. Suppose in a stock exchange there is a share Z. There is a security called as what? Security Z. And look at this point. This is the point. For this risk, it is giving a following return. Respond. Yes or no? No. This Z is inferior to what? 4 as well as what? 5. Because the 5 gives what? More return for the same risk. But the 4 gives what? Same return. The 4 gives what? Same return for a lower risk. That means the Z is inferior to 5 as well as what? 4. Right or not? So, any point in the graph which are below efficiency frontier or inefficient point, yes or no? Or to put it simply, any share in the share market or any portfolio of shares in the share market which does not fall on efficiency frontier or inefficient shares or inefficient portfolio, yes or no? On those shares, no fool will invest, is what Markowitz says. Are you following what I am saying? Yes, don't use the word fool. No rational investor. That's what he says. No rational investor will invest. That is going to be opposite. I said that's all. Okay, it seems harsh here. No rational investor will invest in a security which is what? Inefficient. Is what Markowitz says. Right or not? My question is, suppose there is a share which is above efficiency frontier. The share which is what? Above efficiency frontier. Now tell me, this share is superior to the shares in efficiency frontier or not? Then what you will do? No, the question is wrong. Then this is not the efficiency frontier. The frontier changes. Right or not? Now, see, that is not a efficiency frontier water change. The boundary has to be changed. Are you following what I am saying? So, there can never be any share which lies above what? Efficiency frontier in the stock market. If such a share exists, this is not your efficiency frontier. The frontier shall be what? Redrawn to include that particular share. Everybody, are you following what I am saying? This is the concept called as efficiency frontier. The first basic lesson in Markowitz. From this, they ask a number of examination questions also regarding identification of efficiency frontier or efficient portfolio. Can you start doing a sum in this regard or not? Before that, let us write the efficiency frontier notes and then proceed. Now, what you written up to this year? Okay, right, first. Part 1. Efficiency frontier. Part 1. Efficiency frontier. So can I say, we have lot of time to discuss. We need not hurry things. Okay, we are on track in the syllabus. Only thing is, if you don't understand immediately, stop and ask me. In these areas, if you have a suboptimal understanding, you will never understand with clarity the later stage. Put the hard effort to understand what is being discussed, each and every point. Okay. All are simple common sense logic only, but it develops into great concepts later. Can you see? Now, first, part 1. What is the part 1 I given? Efficiency frontier. In that point number 1. Point number 1. In the above diagram, we had 6 portfolios. In the above diagram, we had 6 portfolios in different combinations of A and B. In the above diagram, we had 6 portfolios in different combinations of A and B. In different combinations of A and B. Point number 2. Out of the 6, we can straight away reject. Out of the 6, we can straight away reject portfolio 1 and 2. Out of the 6, we can straight away reject the portfolio 1 and 2 because we can straight away reject portfolio 1 and 2 because they are inferior to. We can straight away reject portfolio 1 and 2 because they are inferior to. Fill in the blank. They are inferior to what? Portfolio 3. Because they are inferior to portfolio 3. They are inferior to portfolio 3 since 3 gives what? More return for lower risk. Since 3 gives more return for lower risk. 3 gives more return for lower risk. Everybody, can I proceed or not? Next. Point number 2 or 3 or 4? Point number 3. The remaining portfolios 3, 4, 5 and 6. The remaining portfolios 3, 4, 5 and 6 can be called as. The remaining portfolios 3, 4, 5 and 6 can be called as efficient portfolios. Can be called as efficient portfolios. Can be called as efficient portfolios. Point number 3 or 4? 4. An efficient portfolio is the one which does not have. An efficient portfolio is the one which does not have any other portfolio. An efficient portfolio is the one which does not have any other portfolio or any other security. An efficient portfolio is the one which does not have any other portfolio or any other security that gives point A, higher return for lower risk. Point A, higher return for lower risk. Point B, what is point B? Higher return for same risk. First is higher return for lower risk. Point B, higher return for same risk. What is point C? Same return for lower risk. Same return for lower risk. Same return for lower risk. Point number 3 or 4 or 5? 5. The curve consisting of all securities. The curve consisting of all securities which are efficient. The curve consisting of all securities which are efficient. The curve consisting of all securities which are efficient is called The curve consisting of all securities which are efficient is called what? Efficiency frontier. Is called efficiency frontier. Is called efficiency frontier. Is called efficiency frontier. Never? Any doubt? Both, yeah. Securities also can be on the curve. Portfolio. Portfolio is also nothing but combination of security. Correct? Now, see, don't get confused about portfolio or security. Now, for example, this 6 is a portfolio security. It is 6 is a security. Only B is there in 6. This is having a security also having what? Combination of securities. Portfolio consists of another package of assets. That's all. Are you following what I am saying? Don't differentiate so much between portfolio and security. One security calls what? Security. Multiple combination calls what? Portfolios. That's all. Any right or not? Yeah. Can I proceed? Now, next point number 6. The efficiency frontier starts with. The efficiency frontier starts with. Can you fill out the blank? Starts with what? Minimum variance portfolio. The efficiency frontier starts with minimum variance portfolio. An efficiency frontier starts with minimum variance portfolio. An efficiency frontier starts with minimum variance portfolio. Last point. Point number 4 or 5 or 6 or 7. All securities or portfolios. All securities or portfolios. All securities or portfolios below efficiency frontier. All securities or portfolios below efficiency frontier. Tell me, are all efficient, inefficient term or inefficient securities? All securities or portfolios below efficiency frontier or inefficient securities or portfolios. Or inefficient securities or portfolios. I am always using the word together, securities or portfolios. One asset means security, multiple means what? Portfolio. Both are investments only, yes or no? Or security or inefficient securities or portfolios. There cannot be a point, continue, there cannot be a point above, there cannot be a point above, there cannot be a point above efficiency frontier. There cannot be a point above efficiency frontier. If there exists such a point, full stop, continue. If there exists such a point, then the frontier changes. If there exists such a point, then the frontier changes. If there exists such a point, then the frontier changes. If there exists such a point, the frontier changes. Everybody, yes or no? Rumba simple here. All the villages on line of control is India's boundary, yes or no? All villages before line of control belongs to what? India. Suppose there is an Indian village after the line of control, then what do you say? Change the line of control. How China does, yes or no? Change the line of control. You cannot say, so India is there beyond line of control. Nobody can say, because the line of control what? Change. This is a frontier. This is what? A frontier. If there exists another portfolio, the frontier what? Change. Don't say there's a point above efficiency frontier. It is absurd to say. Everybody, are you following or not? Now, with this, we complete this particular point. Enappa, right or not? Now, last point. I forgot. Point number 7 or 8 or 8. Let's have an even numbers. Okay, point number 8. Last point. What here? Point number 8. What are you saying? Okay, write on point number 8. Don't talk. We have seen how to construct. We have seen how to construct efficiency frontier. We have seen how to construct efficiency frontier for a market consisting of two securities. We have seen how to construct efficiency frontier for a market consisting of two securities. for a market consisting of two securities. In the same way, one can identify efficiency frontier. In the same way, one can identify efficiency frontier in a market consisting of, how many securities? N securities. In the market consisting of N securities. I hope everybody are you comfortable or not? Now, in examination, there is a very popular type of problem in efficient portfolio. Very simple. Let us quickly complete question number 9 and then continue with question number 8 in the next stage. Can I proceed or not? Now, please take question number 9. Question number 9 is all about what? Efficient portfolio and efficiency frontier. For that, we are discussing a examination problem. Can we start or not? Now. Take question number 9. Please, take question number 9. Following data regarding 6 securities A, B, C, D, E and F. A gives a return of 8% for a risk of 4%. B gives return of 8% for a risk of 5%. Like that, they given for all the 6 securities return as well as what? Risk. Now, I have a doubt. How they would have calculated this particular return here? Expected return or mean return. What is the standard deviation? Sigma A, sigma B, sigma C, etc. Now, this is only 6 securities. They don't have the portfolio. Just answer the question as they ask. Okay, there are 6 securities. Which of the securities will be selected? Assume perfect correlation. Analyze whether it is preferable to invest 75% in security A and 25% in security C. That's a question which is being asked. Can I start doing the problem or not? No. Okay. Let us see which securities are efficient, which are inefficient. If I identify inefficient, the remaining are what? Efficient. Tell me. Security A is efficient, is inefficient, not inefficient? All of you, tell me what is an inefficient security that exists another which gives you a higher return for a lower risk, higher return for a same risk, same return for a lower risk. Accepted? Now, look at this and tell me, security A is giving you how much return? 8%. And how much risk? 4%. Is there any other security giving more return for the same 4% risk? No. Any correct? No. Is there any other security which is giving same return for a lower risk? No. A is efficient. Enna right or not? Observation. Yeah. Next, come to B. Is B efficient or inefficient? Why is B is inefficient? A gives the same return for lower risk, or E gives what? A more return for same risk. So B is inferior to what and what? A and E. So B can be called as an inefficient security. Ennappa right or not? No. Come to C. C efficient or inefficient? Efficient. Okay. D efficient or inefficient? Inefficient. And now for D, A gives what? More return for the same risk. More return for what? Same risk. It is inferior to what? A. E is efficient or inefficient? E is what? Efficient. F efficient or inefficient? Why F is inefficient? Because for a lower risk, for risk of what? 5. For a lower risk, E gives you what? Higher return. Isn't that correct? So E risk is 5, F risk is what? 6. E is having lower risk but gives you what? A higher return. Also F is inferior to what? A also, because for the same return A is having what? A lower risk. Inferior to B also, because for the same return having what? A lower risk. Enna right or not? Now, any number of inferiority one can find out. If I find out one inferior itself, it becomes what? Inefficient. Right or not? Now, tell me, A, B, C, D, E, F. 6 securities are finding in stock market. Don't look at portfolios and all. Question does not ask you. Are you following what I'm saying? We are asking the correlation to be 1 plus 1. Then portfolio also gives you what? The same only. Risk ratio will not take place. Right or not? Now, don't worry about portfolio. 6 shares are there in the share market. My question is, in which share you will never invest? You will not like which shares? Tell me. B, D and then F. Because B, D and F are inferior to the other securities which you will not be investing. Yes or no? That means A, C and E are called as what? Efficient securities. Which join those points, I get what portfolio? Efficiency frontier. I get what frontier? Efficiency frontier is the answer for the first part of the question. Respond. Yes or no? Like examination problem here. Can I proceed further? Now. So now let us answer the question. Now write down first. Part 1. We'll do it together. Right? Part 1. Identifying inefficient securities. Identifying inefficient securities. Identifying inefficient securities. Okay. Now, the first inefficient security is what? Security B. Security B. Inferior to, please answer me, inferior to what? A and E. Inferior to A and E. Can you tell me the reason why it is inferior to A and E? A gives same return for lower risk. Then E gives what? High return for same risk. Write down. A gives same return for lower risk. You have to state the reason, okay, in the examination, because it's only an observation problem now. You have to say the reason. A gives same return for lower risk. A gives same return for lower risk, and E gives higher return for same risk. And E gives higher return for same risk. And E gives higher return for same risk. Respond. Yes or no? Okay. Next security is what? Have you all finished writing up? Now. Please write along with me. Can I proceed? Next security is what? D. Next security is D. D is inferior to A. D is inferior to A. Why D is inferior to A? A gives higher return for same risk. 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 Everybody comfortable? Now, next security is what? F. Next inefficient security is F. F is inferior to A and E. Even can also include B also. Already inferior left out, we can see two efficient inferior to what? A and E. Okay, that is enough. F is inferior to A and E. Why it is inferior to A and E? A gives same return for lower risk. A gives same return for lower risk. A gives same return for lower risk. And E gives higher return for, and E gives higher return for, E gives higher return for lower risk. E gives higher return for lower risk. E gives higher return for lower risk. Everybody, are you comfortable or not? Now, first part of the question has been answered. Can you move to the second part or not? No. Assuming perfect correlation. Perfect correlation means what? Plus 1. Don't say, sir, they did not say perfect positive or perfect negative. Normally, no adjective means it is always assumed to be perfect positive. Negative, you know, they have to say as what? Perfect negative. Right or not? So, when I simply use the word perfect correlation, it means what? Perfect positive correlation. One should understand it. Can I proceed or not? Now, perfect positive correlation, R is equal to what? Plus 1. They want to now combine the two securities, what and what? A and C. In what proportion? 75 proportion and 25%. A and C. This is a single security, portfolio. how A can have a return, B can have a return, C can have a return, D, F and can have return. Like that they can also have a risk. So to the portfolio also can have what? Return and risk. Is a portfolio consists of A and C. In what proportion? 75-25. Now we have to find out portfolio return and portfolio risk. Write down. Next. Step part 1 or part 2 or part 2. Part 2. Calculation of portfolio return. Calculation of portfolio return of A and C. Calculation of portfolio return of A and C. Calculation of portfolio return of A and C. Stop writing old discussion. What is the return of a portfolio? Weighted average return of the individual securities. Yes or no? Now, tell me the column securities. Securities. Second column proportion. Return, weighted returns. Security, proportion, return and then weighted returns. Tell me the two securities A, C. What are their proportion? 0.75, 0.25. 0.75, 0.25. What is the return of A and C? Given the question, look at the return and tell me what it is. 8, 12. 8 and then 12. 8 into 0.75, 6. 12 into 0.25, 12 into 0.25, 3. Okay. What is the total here? 9. The expected return is 9%. Portfolio return is 9%. Now we have to find out sigma P or not. Everybody tell me what the formula for sigma P is. Square root of W1 square sigma A square plus W2 square sigma C square plus 2 into W1 into W2 into sigma C into correlation A and C. Yes or no? Not required. Simply what? W1 sigma A plus W2 sigma C. Respond yes or no? Why? Correlation is +1. Remember, write down. Next. Step 2 or step 3? Step 3. Portfolio risk. Portfolio risk. Can I proceed? Now. Sigma P is equal to W1 sigma A plus W2 sigma C. Sigma of portfolio, standard deviation of portfolio is equal to W1 standard deviation of A plus W2 standard deviation of C. Why such a simple formula? R is equal to +1. Okay, now 0.75 into 4, 0.75 into 4 plus 0.25 into 12. 0.75 into 4 plus 0.25 into 12. Can tell me what is the standard deviation of the portfolio? Tell me it is how much? 6%. Standard deviation of portfolio is 6%. Okay. The portfolio, write down next line. The portfolio is analyzed as follows. The portfolio is analyzed as follows. Whenever any stock or a portfolio I take, I want to know two things about them. What is the return? What is the risk? Financial asset, these two only you should know. Want to marry a person, we know what is his height, weight, education, etc. not. But when I want to marry a share, I don't want to know so many things. I want only two things. One is what? What is his return? What is risk? Always selecting financial asset is the easiest. Selecting bride or bridegroom is what? Most difficult. Can I proceed? Now. So, now let us continue. Now, portfolio return 9%. Portfolio return 9%. This portfolio is expected to give me how much return? 9%. Risk. Portfolio risk. Sigma P how much percent? 6%. Portfolio return 9%. Portfolio risk is 6%. I want an answer. Is it a good portfolio or not? It is efficient or inefficient? Look at the workbook and tell me, it is efficient or inefficient? E gives for the same 5% risk, 9% return. No? This portfolio is inefficient to what? E. Right or not? Because E gives what? More return for the more same return for a lower risk. Not? Now, so this portfolio is inefficient. Write down. We should not invest in we should not invest in this portfolio because we should not invest in this portfolio because it is inferior to. We should not invest in this portfolio because it is inferior to. It is inferior to what? E. Because it is inferior to E, which gives, it is inferior to E, which gives what? Same return for lower risk. It is inferior to E, which gives same return for lower risk. Which gives same return for lower risk. Everybody, are you following or not? Now, let us draw this as a efficiency frontier. My diagram will be very approximate, somewhat horrible. You draw it correctly. Okay, now, then we can just move on to the, we continue with what? Markowitz. Just now we started Markowitz. We have a lot of issue to discuss further now. We continue once we just put the sum in the form of a graph. Can I start or not? Now, please. Shh. Please. Shh. Can you start or not? Please. Shh. Tell me what is there in x-axis. All of you, please do along with me. Risk. What in the y-axis here? It is going to be return. Please. Shh. Let's do it together. Now, risk and return. We have it in intervals of 2, 2, 4, 6, 8, 10, 12. The risk is 2%, 4%, 6, 8, 10, and then what? 12. Return also can be 2, 4, 6, 8, 10, and then 12. Okay. Now, please do along with me. I will not give you time to copy it. Do quickly along with me. Can I proceed or not? Now. Please be serious. Can I proceed? Now. Let's start plotting the points. Tell me security A is having how much percent return? 8%. How much risk here? 4. Risk is 4 and return is what? 8. And this should be the point that represents security A. In a right or not? In a return is 8, risk is 4. I call this as security A. In a accepted? Now. Next. Security B, the return is what? 8. The risk is what? 5. 5 is somewhere here. So it is in between. The return is what? 8. And risk is 5. I call this security as what? Security B. I call this as security B. Am I right or not? Next. Come to see, it is giving what? 12% return for what? A 12% risk. So this is 12, 12. This is going to be the security C. We call the security as security C. Now, D gives you 4% return, 4% risk. This is 4% risk and this is what? 4% return. We can mark this as what? Security D. We mark this as security D. E gives 9% return for 5% risk. This is 5% risk. The return is how much here? 9%. There is something here. Am I right or not? So it is 9% for 5%, which I call as security E. F 8% return for how much percent risk? 6% risk. 6% risk, the return is what? 8%. This I call as security F, which I call as security F. Everybody, are you following up? A, B, C, D, E, and F, all the securities has been what? Plotted here. Respond yes or no? Now, if I join A, E, and then what? C. A, E, and then what? C. This I call as what here? Efficiency frontier. We can just extend this way, which I call as what? Efficiency frontier. Which I call as efficiency frontier. Am I right or not? No. This curve assume it is not. This coming down and going. That's handwriting efficiency frontier. Can I proceed or not? No. Tell me, is D, next what? B and then F. D, B and then what? F. These three securities are efficient, inefficient, inefficient. Why it is inefficient? It falls below what? Efficiency frontier. Ennappa, right or not? No. We have a portfolio consisting of what? A and C. What the return of the portfolio? 9%. The return is how much percent? 9%. The risk is how much percent? 6%. So 6% return, risk, and then what? 9% return is something falling here. In the something falling here. This I call as what? Portfolio. I got this portfolio. This portfolio is on the efficiency front, below it, below it. It's a efficient, inefficient, inefficient portfolio. Respond yes or no? Now have you plot of the points? Now write down. Conclusion. D, B and F. D, B and F along with the latest portfolio. D, B and F. D, B and F along with the latest portfolio are inefficient because along with the latest portfolio are inefficient because why they are inefficient? Because what? They fall below because they fall below efficiency frontier. Are inefficient because they fall below efficiency frontier. They fall below efficiency frontier. They fall below efficiency frontier. Now with this we have completed solution to question number 9. Everybody, are you comfortable or not? Now. So can we continue with the Markowitz portfolio theory or not? Now let's go back to the Markowitz now. Question number 8. Small scale irukkumappa. Scale. Small scale. Small scale, yeah. Small. Okay, don't talk, please. Please stop talking. See, in the stock market, please. In the stock market, there are so many securities that are available for investment, starting from MTHK share till a TCS share or an Axis Bank share, etc. Right or not? So there are varieties of securities, so many securities available in the stock market for you to invest. You are very much amused how to invest and how to find the right combination. Markowitz said very simple, with the help of the data find out the efficient frontier. Yes or no? Stop talking. Invest only those securities or portfolios which are sitting on the efficiency frontier. There can be so many other combinations as well as what? Securities that can fall below the efficiency frontier. Those things never touch because they are inefficient. Are you following what I am saying? So as an investor, you should be sitting in one of the portfolios on the efficiency frontier. Up to this, are you following or not? So he said, what shares or security to look for in the market? Look for those portfolios or securities that are in what? Efficiency frontier. I said how to find out for a two security portfolio, the efficiency frontier. One can find out the different combinations and securities for what? N securities. Again I say, don't worry about how they do it. Don't worry about what? How they do it. How to manage 100 or 200 securities. That you don't worry about it. Only understand the concept. So now, how we can have an efficiency frontier frontier for a 2 security share market and have an efficiency frontier for what? 100 security share market also, I should place my money only in one of the portfolios or shares which are sitting on what? Efficiency frontier. I should not put money in any other share or in any other portfolio that falls below the efficiency frontier is the first conclusion Markowitz has made. Are you following or not? Now the next question is, okay. Okay, I know that I have to find one of the portfolios on this curve and then invest. The question is, should I invest in portfolio 3 or can I invest in portfolio 4 or can I invest in portfolio 5 or 6 or anything in between? Question arises, no. Now, I know that in one of them I should invest. All are efficient. All are what? Efficient. Which I should invest? Invest in 6 or 3? It depends on the person. Now we are shifting from market to what? The investor. We are shifting from market to what? Investor. 2 persons here. For a marriage to happen, 2 persons should be there. One is what? A girl and boy. Yes or no? For an investment to happen, also should be investor and the security. Yes or no? Now we discuss about security. These are all the best available in the market. We understood. Yes or no? Out of the best, we cannot marry all. Yes or no? It all depends on what? Can you listen? We lose continuity, please. Shall I proceed? Now, which security invest? It depends on the investor's risk appetite. Investors want a risk appetite or the investor preferences. Now we shift from the market to the investor. Let's have some discussion about investor and then come back to market. Everybody follow or not? So for investor, we discuss a concept called as utility curve. You can discuss a concept called as what? Utility curve. Economics you have studied in the CPT, yes or no? They also call as indifference utility curves or utility curves. So we discuss about the investor preference and then come to what? Market once again. Can I proceed now? So let's have a small discussion regarding the investor and then come back to market. Okay. Now, see, let us take an example. You have 2 choices. You have how many choices? 2 choices. Option 1 and option 2. Please. Option 1 and option 2. Option 1 will give a sure return of 50 rupees. How much rupees here? 50. If you go for option 1, you will be getting a 100% sure return of what? 50. Option 2 may give 100 or may give 0. May give 100 or what? May give 0. There's a 50% chance of getting 100. There's a 50% chance of getting nothing. That means option 2, the expected return is how much here? 50. Okay. Option 1 also the return is 50. Option 2 also the expected return is what? 50. What is the difference between option 1 and option 2? Option 1 is no risk 50. Option 2 is what? A risky 50. Right or not? You understand the 2 differences or not? Now, tell me, you will like option 1 or option 2? Option 1 or option 2? Okay, now. These discussions, again I say, very simple, but the wavelength should be set. Whatever I discuss, you have to understand, it should be on the same page. Otherwise, ask me, I'll explain and proceed further once again. Okay, now, we have 2 options before us. Option 1 is giving us a 50, which is certain, a guaranteed 50. And number 2 is what? An expected 50, which can be 100 or what? 0. And on an average, expectation how much? 50. Or 2 options before you. The question is, will you go for a guaranteed 50 or an expected 50? Yes or no? And most of them will say what? I'll go for what? Guaranteed 50 because it is having no risk. Right or not? So, we are called as risk-averse investors. We call as what investors here? Risk-averse investor, because we place we don't want to take what? Risk. First option, we don't want to take what? Risk. If we want to take risk, we want more return. Are you following what I am saying? So, we are all called as what investors here? Risk-averse investor. Throughout the world, 99% of the investors are what? Risk-averse only. Respond. Are you following or not? Apart from risk-averse investors, there are 2 more investors. One is risk-loving investors. Who is what? Loves risk, yeah, risk loving investors. And number 2 is what? Risk neutral. Next person is what? Risk neutral investor. I'll give you the examples in the same problem and then go for the next stage. Please, can I proceed now? See. A risk loving investor says he likes to take risk. He likes to take risk. He says, I don't want a guaranteed 50. I have a chance to make 100. He does not like to take 50. He has a chance to make what? 100. So he says, I'll go for the expected 50. I don't want to go for what? A guaranteed 50. The person is called as a risk-loving investor. Are you following or not? Now, even there can be persons where if the expected return is only 40, what expected return is 40. Suppose the probability is 0.4 and then what? 0.6. Well, expected return becomes how much? 40. Still, he may go for that particular 40 because he does not want to see the return. He wants to only see what? The maximum. He loves to take what? Risk. He thinks, I like to go for the risk because I have a chance of earning what? 100. A risk-loving investor is willing to take what? Risk. He is a person who loves to take risk. Are you following what I am saying? Don't think, sir, will there be any person like that? I am guaranteed 50. Why should I go for what? A 40 expected return for 100 risk. Question arises, no. Is anybody going like that? It happens in day-to-day life itself. For example, we do it in a mini scale and people do it in what? Large scale. All sentiment only. Okay, very simple. Yeah, you buy a lottery ticket. You buy a lottery ticket. Nah, you suppose pay 20 rupees to buy the lottery ticket. Understand or not? Now, the 20 rupees is a sure outflow. Yes, out, you pay 20, yeah, okay. The expected cost is sure, yes or no? But if you say the expected return, don't say it is having a chance of having what? 1 crore. But probability will be less than 20. Right or not? See, are you following what I am saying? Very simple. You buy a lottery ticket. In the lottery ticket, the expected return is more than the actual cost. Because the lottery ticket may say 1 crore is what? The 1 crore is a price money. Okay. You look at the probability of getting what? That 1 crore will be very, very minuscule. Yes or no? Even your expected may be 0 for the probability. Right or not? But still you pay 20 and buy it now. Why you pay 20 and buy it? Not out of logic. You are a risk lover. You want to make that 1 crore somehow. Are you following what I am saying? That is tempting you to take that particular risk. Yeah. So here don't go for the financial logic. It is sentiment. It is more about what? Psychology rather than the actual finance. Are you following what? The market works both psychologically as well as what? Actually. In that case, risk lovers will always search for options that is taking what? More risk. Because they are very excited about the higher risk rather than about the certainty. Are you following what I am saying? It can be 1,000 above 0. For 1,000 probably also can be what? 0.2. No worry, because I have a chance of earning what? 1,000. He is what a risk lover thinks about. Are you following what I am saying? So the two investors now, risk covers. Risk averse always want to avoid risk as much as possible. You want to make them take the risk. You have to motivate them by having what? More return. And the risk lovers is always going for what? The risk taking in expectation of a higher return. Are you following that? Third person is called as risk neutral. Called as what? Risk neutral. He says 50-50. He says, this is also 50, this is also 50. Both are equally same only. I don't worry about risk at all. I don't worry about what? Risk at all. The risk may be there, risk may not be there. He does not see risk. His only aim is to what? Serve with the maximum return. For example, 50 is certain and 60 what? Uncertain. You go 50 or 60 or 60. Or it is 60 is certain and then what? 50 uncertain. It goes for what? 60. That is, he sees only which is giving more return. He does not see the risk angle at all. The person is called as what? Risk neutral person. This person is going to be a very important person in option valuation later. Where a model called as risk neutral valuation. Everybody following or not? Now, every point which I am saying are all information set to you, which are all the concepts used here and there somewhere in what? Valuation. Everybody following up. One problem is our institute study material or others doesn't link all this in understanding how the actual investments are generally made. But this is one should be understanding the Markowitz from the angle of the investors. Are you following up? Now, my question is, the three types of investors who may be there, name the three: risk loving, risk neutral, and risk averse. Risk loving investor loves to take what? Risk. more risk, he is enjoying what? Taking the risk. He does not see the expected return, always see what? The probability of a highest return. Everybody follow what I am saying? Number 2. The second person is what? Risk neutral. He does not see risk at all, he sees only return. If there is a 30% return and a 20% return, he only selects what? 30%. He doesn't worry for the 30% of what the standard deviation. He never calculates what? SD at all. He only looks at what? Return. Such an investor is called as what? Risk neutral. And the third category is what? Risk averse. What is the third category? Risk averse. What a risk averse investor does here? He wants to avoid risk as much as possible. There are two options. One giving 50 guaranteed, other giving 50 with what? Risk. He goes with what? Guaranteed 50. Respond yes or no. And if you want to take more risk, that is, if you want him to take what? More risk, you promise him more return. Are you following what I am saying? That is, if you want to go for the gambling, he should not be offered 50, he will be offered what? 60 or 70. Everybody, are you following what I am saying? In case of risk averse investor, he is averse to take what? Risk. If he wants to take risk, he charges a premium for taking the risk. Yes or no? So, the risk premium concept, the concept of risk premium comes only for which investor? Risk averse investor. Risk neutral, asks for zero premium, and risk loving, in fact, is willing to pay premium for taking a risk. You know what I am saying? You go for a gambling, in the gambling, you pay money to take a risk. Yes or no? I am taking risk, so you have to pay money. Nobody asks, share market you ask, you don't ask in what? A casino you go, you pay money and what? Take the risk. Horse riding you do, you pay money and what? Take the risk. Yes or no? He is willing to pay money for the excitement which is going to get for the risk. Yes or no? Risk lover always goes for excitement. Risk neutral is like a sannyasi, not worry about what? Risk. Risk averse is calculated. He does not want to take a risk unless he is offered what? A premium for taking that. These are the three categories of investors. Are you following or not? Now, this should not be disputed. Throughout the world, they have made observation for over past 80 years. How many years here? 80 years. And they found out that almost 99% of the person entering into the share market are risk averse. Are what? Risk averse. That is, they will ask for premium for taking what? Risk. You cannot argue any share market theory keeping in mind what? A risk lover or what? A risk neutral person. Everybody yes or no? No. Always people develop theories only with some background proof. Okay. The proof they will be doing through what? Empirical research. Now they found out that in the share market always more risk when the market had, the people ask for what? More return, and less risk they ask for what? Less return. And the market is full of what? Risk averse investor only. Surely there exists a concept called as what? Risk premium. Everybody yes or no? In the concept is now disputed in another area called as behavioral finance. There's another subject called as what? Behavioral finance, where they say this risk premium and all go for real estate. What premium you are charging? Yes or no? What risk you are taking? Why you having what? So much price. So they say all purchase and sale is more about what? Excitement rather than what? The real financial value is another branch that is slowly developing, but till now everybody accepts this economics called as neoliberal economics, where everybody is what? Risk averse, and only maximum 1% can be risk neutral or what? Risk lovers. Everybody, are you following or not? Now tell me, all the persons in the share market are assumed to be what person? Risk averse person. For taking a risk, will they take risk free? For taking this, they ask for a risk premium. Everybody up to this, are you following or not? No. How averse you are, so much premium you want. How averse you want, so much premium you want. If you are more risk averse, you ask for what? More premium. If you are less risk averse, you ask for what? Less premium. Here is the next issue. Everybody following or not? Now, come to the next discussion. See. So risk neutral, don't forget it. Who is a risk neutral person? He is neutral about risk. Whether risk is there, not there. He plays the same value, so no. And we'll look at them once again in the option valuation model later. Okay, now see. Take a situation where, situation 1, I get a guaranteed 50 rupees. I get what? Guaranteed 50 rupees. Situation 2, or I get a guaranteed 40. How much rupees here? 40 rupees. Situation 2, I get a expected return of 50. It can be 100 or what? 0. Same situation here. I give you a choice. Do you want An expected 50. Do you want what? An expected 50 or a guaranteed 40? Did you understand my question or not? Now, the question is changed. If you are risk averse, now accept it or not, all of us are what? Risk averse. In this, I am asking first question. You want expected 50 or guaranteed 50? You all say what? Guaranteed 50 because expected 50 has got a risk. I know what I am discussing. Please. First question ask is, we are all risk averse or not? Expected 50, guaranteed 50. What is your result? Because expected 50 is having what? Risk, and guaranteed 50 is having what? No risk. With a no risk, I am getting 50. With the risk, I am getting what? The expected 50. Now, I always go for what? Guaranteed 50. There are no problem at all. All of us are on the same page. Yes, other efficient portfolio, right? What I am saying? Now, my next question is, now, expected 50, guaranteed 40. I just make a change. Expected 50 or what? Guaranteed 40. Right? That is, you want risk-taking 50 or riskless 40. Tell me what is the answer. Risk-taking 50, riskless 40. Now, some says, sir, I want riskless 40. Some may say, I want risk-taking 50. It all depends on how much risk averse you are. Yes or no? There's an aversion coefficient for you. That's going to be what? A risk aversion coefficient for you. Coefficient means what? A number attached to a risk aversion. Are you following what I'm saying? Some may be very risk averse and some may be what? Less risk averse. A very risk averse person may be going for what? 40 instead of what? A 50. Yes or no? A person who is less risk averse may go for what? This gambling and go because he says, I get only 40 return. I'd rather take the risk for going for expected 50. One can go. Yes or no? In the situation, two persons can make two decisions. Yes or no? If everybody 50-50, it is going to be safe. But in these situations, that is going to be happening in stock market always. One security, more risk, more return. Another security, what? Less risk, less return. This is less risk, less return. This is what? More risk, more return. Both are efficient. This is also as per Markowitz. This 40 also efficient. This 50 also what? Efficient. We'll go for this 40 or 50. It depends on what? Your risk aversion. So how much you are risk averse depends on a utility curve. Depends on what? Utility curve. For that they have to have a curve called as what? An utility curve. Everybody, are you following what I am saying? Issue now. So some derive in the utility, some derive more satisfaction by investing in 40 without risk. Some derive more satisfaction by investing in what? 50 with risk. So the utility is your satisfaction level. It is what your satisfaction level. Ultimately, one should be happy after making a decision. When you make a decision, one should be happy or not. Your happiness of two persons can come in two ways. One become happy if he decides to go for a 40 with a lower risk. Another be happy with this go for what? 50 with a higher risk. It depends on the risk appetite of an investor. Are you following what I am saying? I may be happy in going for a stock which is more stable. You may be happy for what? Stock which is promising to give what? More with a higher risk. Are you following what I am saying? Ultimately, both should be having a happiness which is almost same. The choice may differ, but the happiness should be what? Same for both of us. Yes or no? And what happiness you derive, I call as what? Utility. I call as what? Utility. This utility is having an equation. Is having what? Equation. We call as utility function. That equation nobody should question. It is once again empirically proved. Are you following not? Now, the equation of utility is utility is equal to expected return. Utility is equal to what? Expected return minus half into A into sigma squared. What is utility here? Expected return minus half into A into sigma squared. Something suddenly come like an examination, you know what it is. I don't know. That is what I am discussing. The called as what function here? Utility function. Called as what function? Utility function. Okay. Now, the word utility is happiness. The word utility is what? Happiness. They try to put some number. Everybody accepted that this cannot be measured. This cannot be what? Measured. But somehow they try to put what? Some number into it through this particular equation. So the word utility means what? Happiness. What I am discussing. Shall I proceed further? Now, what is that happiness? Very simple. I have a stock. A stock can give me more utility. A stock can give me what? More utility or more happiness due to following two reasons. A stock which is giving more return will give more happiness. Yes or no? If this number is instead of 50, 80, I get more happiness from this choice or not? So an option, a security will give me more happiness if it is expected to give what? More return, yes or no? So my utility can increase if the expected return of the stock is more. Are you following what I am saying? The other way to gain happiness is a stock may give happiness if it is less risky. If the standard is nothing called as what? Variance. If the variance is what? Less risky, the stock may give me happiness. Enough right or not? So, a stock can give me happiness in two ways, either being a high return stock or what? A low return stock. Both are captured in this particular thing. Yes or no? That means, tell me, in our Markowitz series, 3, 4, 5, 6 is there. Yes or no? 6 can give me happiness. So, 3, 4, 5, 6 is there. 6 can give me happiness. Yes. How it gives happiness? Through more return. 3 can give me happiness. Yes. How can give? Now the question is, which gives you more happiness, 3 or 6? It depends on your A, the aversion factor. It depends on whether A called as what? Aversion factor. How they capture A? They capture through questionnaires. They capture through what? Questionnaires. Okay. If you go to any investment bank, if you go to any say consultant for what? Investing, he gives you a big sheet, asks you to take questions. Yes or no? They say, what is your age? What is your age? You have to take the right age. No. Okay, 60. I'm not asking a father's age, your age. Can I say? No. Wait. Like that, they're asking you, what is your income? Okay. How much already invested in what? The other securities. Now, whether you're planning for a retirement or whether you're planning for what? A speculative income. Like that, they ask you so many questions here. The way you answer the question, they give a rated point. They give you what? A rated point. Based on the point, they try to capture your risk appetite and then ask you for an interview, confirm it once again before they go for investment. Are you following what I'm saying? Now, this how they find out, don't ask me. It all depends on your answers to the question they ask. Are you following what I'm saying? If you have seen some of the investment weeklies, they frequently ask 10 to 12 questions like this very famously. And when you answer the question, they give you multiple choices. They'll give you what? Multiple choices. And based on your answers, they'll be giving some weighted points for answer. Based on that, they find out what? The adverse risk averse factor is called as aversion coefficient or what? Aversion factor. Respond yes or no. Now see, what Markowitz says is that I can gain happiness. The word happiness means what? Utility. Utility can be more if the return is what? More. Or risk is what? Less. So one can gain happiness in investing in a high return security or low risk security. Which security you want to invest depends on what? Your risk aversion factor, which is found out through generally the questionnaires. And this formula, don't ask me, it is used popularly throughout the world. It is coming from the economics theory of marginal utility. Everybody, are you following what I am saying? So this is called as the utility function. Ennappa, right? Please respond yes or no. No. We are all discussing now what theory? The theory, how to make investment. That is how to make investment. See, this theory is going to lead us to what? Capital allocation line, CML and so on. I am just slowly building the various areas. The problem that can be asked in between the areas also we are discussing. Respond, are you following up? No. So this is called as the concept of utility. Can I proceed further or not? No. I'll put a diagram now to explain the utility and then give you the notes in this regard. We'll do one problem, not the workbook problem. I'll dictate one small problem to just find out the utility and then go for the next stage, identifying the efficient portfolio. Everybody following or not? Now, first of all, everybody understanding my discussion? Yes, those who are understanding the discussion, raise your hand. Okay, can I proceed? If this chapter I cross, I escape. I'm sure not. Till then only I'm feeling always difficult. Every batch. Can I proceed? Now, see. Let us summarize and see one slide, 2 slides to see about utility curves and the nature of the curve and then go for the last stage. Okay. Now, let us summarize what we have discussed here. Till now, Markowitz was discussing about market. Kadava. In the market, there are 6 portfolios, out of which 2 became what? Inefficient. I should put my money only in what? One of the 4 efficient. Why I related 1 and 2? Because I am a risk averse person. If I am a risk lover, I would have gone for what? Any number, okay, 1 and 2 might also have been what? Better and so on. Since I am risk averse, I always go for a security that gives you what? Higher return for a lower risk, etc. etc. What you discussed, right or not? So 3, 4, 5, 6 are the 4 portfolios which are available for investment in the share market. Yes or no? Out of the four, which is best? Question arises, no. The Markowitz answers by saying that it all depends on the investor. All depends on what? Investor. Now the camera moves from the stock market to what? Investor. Focus on the investor. Right or not? Tell me, what are the types of investors here? Risk lovers, risk neutral, and risk averse investors. Right or not? Now, who is a risk lover investor here? Who likes to take risk, who likes to what? Take risk. He even pays for taking the risk, yes or no? Even pays for taking the risk. So, for example, I said 50 guarantee, 100 0, 50 chance. He rather go for what? 100 0, 50 chance because he loves taking the risk. He wants an excitement. Once he invested, he wants to know whether 100 is coming or not. That excitement gives him happiness, not any more, say what I am saying, a rational discussion. Are you follow what I am saying? Really, yeah, he goes for what? Excitement. More the risk, more he gets excited, more he goes for that particular investment. Even by paying a lower price, even by paying what? A lower return for the response. Are you following not? No. There is risk lovers. Risk neutral means he is not worried about risk. He only sees what? Return. Whichever option gives him what? Highest. In the case, 60 will select. Yes, only what? 6. In a 6 gives you what? Highest return. He selects, he doesn't worry about the risk of 1, 2, 3, 4, 5 and 6. Are you following what I am saying? In case of a risk averse person, he doesn't like to take risk. If you want him to take risk, he asks you for what? Premium. He wants more return for taking what? A given level as risk. Yes or no? Now, so we are saying that entire stock market comprises of which person? Risk averse person. The other two are minorities who cannot influence the stock market. Everybody is or no. So we are only discussing about what? Risk averse. For him, he decides there is happiness or not. The happiness what he gets is called as what? Utility. He calls as what? Utility. So utility is equal to formula is what? Expect a return from a security minus half into A into variance. That is standard deviation square. So a security can give happiness if it expect to give more return. Or security can give happiness if it is having what? Less risk. Either you can give happiness to investor by guaranteeing him more return or what? Less risk. So security 3 gives what? Less risk. So it is efficient giving happiness. Security 6 is giving what? More return. Can give you what? More happiness. So a security can give happiness through more return or less risk. Yes or no? And you like to go for 3 or 6. It all depends on your risk aversion factor. Yeah, risk averse person will be putting more unhappiness towards what? Risk. And the balance is going to give him what? Utility. Everybody yes or no? If the aversion factor increases, he is more averse about risk. Yes or no? And the unhappiness magnifies. The unhappiness what? Magnifies. When I have more risk, I am unhappy or not? The unhappiness magnifies through what? The averse factor, risk aversion factor. So through risk aversion factor, I am going to show how unhappy I am about what? Risk taking. Yes or no? Unhappy about the risk taking, and then I just find out this happiness called as what? Utility. Everybody, are you following or not? Now, this is regarding this particular concept called as utility. Can I proceed further? Now, see. 2 slides I will show quickly and then have a brief notes in this regard. I said it's going to be a very long discussion. Not even 40 or 50% of Markowitz are completed. So once we cross this stage and move into CAPM, it becomes much more smoother. Can I proceed? I'm already warning you. Today's class is more like a theory class. We did one problem, but it's not theory. It is what theory? Portfolio theory. Other name is portfolio theories. It is not the theory class. Practically how investments can be made, we are now visualizing. Can I proceed? Now, next. Investor type. I can say. This is our risk neutral, risk averse. Already we know that our investors are what? Risk averse. Risk averse can be of 2 types, namely aggressive and conservative. Correct? Can I proceed? You are averse to take risk. I am also averse to take risk. Everyone of us is what? Averse to take risk. Who said? Markowitz said. So they proved that everybody is what? Risk averse. They want more return for what? Taking risk. How much more return you want depends on who you are. Whether you are aggressive or what? Conservative. Yes or no? I'll give an example. Now, I asked my father, for example, to invest in share market. Will he invest? Yeah, I'll invest in what? Post office, MIS scheme or Kisan Vikas Patra. I will not invest in share market. Yes or no? I say share market is giving 20% return. Post office gives only what? 8%. Please make the investment on share. I said no. For 20% return, I won't take the risk. I'm very happy with what? A riskless 8%. Yes or no? Yes, suppose I say See, there is a share market offer. Share is expected to give 60% return. Everybody is earning how much? 60% return. Can you invest in share market? He'll think return not. That's what happened in mutual funds. Yeah, in the year 2004 to 7 and 8 or not, mutual funds have been reporting 60% return, 50% return. Everybody, yeah, even from beggar to what? Millionaire, invest in mutual fund. Yes or no? Industry was very attractive. Yeah, in that case, 60% promise now, my father will think, why can't I forego the 8% and take the risk for what? 60% because the premium offered is very high. You know, right or not? But instead of my father, if you ask another person, you ask what? Another person, age group of what? 25 or what? 30, who is earning money, to ask him, see, post office gives 8%, share market gives what? 20%, where you post office, see, very bad. Savings bank is 6% giving now. So, I'll go for what? Share market. He is tempted to go to share market by just taking what? 20% for the risk, yes or no? For father to take the same risk, he has to be motivated by offering 60%. For the other person to take risk, he will be motivated by just offering what? 20%. Both are risk covers. Both are what? Risk covers. They want a premium for taking risk. They want more than 8%. So now, how much more they want depends on what? How much risk averse they are. How much risk averse they are. So, father gains the same happiness by investing in stock market only when he is offered 60%. Yes or no? And the other person, son, gains the same happiness in the stock market by investing at what? 20%. Yes or no? Same utility, that is going to be what? Same utility will be obtained by one person who is risk averse by offering higher return, another person who is what? Less risk averse by having what? A lower return. Because the risk premium asked is what? Less. Right or not? The point of can I say? No. That is what this curve says. Now, for example, take a given level of risk. Take what? A given level of risk. Able to see this pointer or not? Yes, point 3 is arrow mark able to see or not? No. Suppose this is a 10% risk. An aggressive investor expects a lesser return for this. But a conservative investor for the same risk wants what? More return. To motivate him to take this particular risk, a conservative should be offered what? Higher return. Then only you go for the security. So no. But for the aggressive, even if a lower return is offered, he takes that particular risk because he is a risk person who is going to want to be less risk averse. Are you following what I am saying? No. So it's called as what? A risk averse person. He is likely to take the risk very quicker by offering less risk premium. A risk averse person is going to take what? More risk premium to be motivated to take that particular offer. Respond yes or no? No. This is nothing great. One can see this from the utility curve itself. Okay. Now, two persons want to have a same satisfaction. Want to have what? Same satisfaction. How much return should be offered? Now, I just reverse the equation. Expected return on a security is nothing but the utility plus half into A into sigma squared. No. So, expected return. Okay. How much return you expect not only depends on the risk of the security, it also depends on the risk appetite. That is, to take this risk variance, to take this one sigma squared risk, there are two things. Your satisfaction level, which you want, as well as what? Your risk appetite. Yes or no? No. Both of us, my father and myself, both want to have the same satisfaction level. Both want to have what? Same satisfaction level, utility, and number can be measured. You have a number or not? So you both want to have what? Same satisfaction level. Accepted? And we are going to see the same security, sigma square, offering what? Same risk. Okay. Now, a same security having a risk and a satisfaction level is what? Same. Now, my father, he expects more return. I expect what? Less return. Why my father expects more return? Because his A is bigger and my A is what? Smaller. Yes or no? I am more risk averse. I am less risk averse. He is what? More risk averse. So, what happens is 2% deriving the same level of satisfaction. I just want to make comparison. Okay. 2% want to be equally happy. Want to be what? Equally happy. Investing what? Same stock. Having what? Same sigma. That is a TCS share having a sigma. That is TCS having what? Sigma. By investing in TCS share, my father also should be happy. I also should be happy. When both will be equally happy? When, if my father is offered more return, he'll gain the same happiness when I'm offered what? Lesser return. Yes or no? Because my father's A coefficient, my father's what? Risk averse coefficient is more than what? My coefficient. That means my father and me are going to be having what? Different happiness based on the risk appetite. Are you following what I am saying? This is what market is saying as types of investors. So, number one, the earlier three types of investors: risk neutral, risk level, risk averse. Invest risk neutral, risk levels, what you do? Went out. Who is staying? Risk averse. In the risk averse person, there can be two types of person: aggressive, conservative. Aggressive person will be having more, that is less A coefficient. Currently having what? More A coefficient. For a given level of satisfaction, a conservative asks for what? More return, and aggressive asks for what? Less return. Because the level of risk taken is same, the satisfaction they want is what? Same, and what changes? The A only. A conservative will be having more A, hence he want what? More return. Aggressive having what? Less A, he wants what? Less return. This is what we call as the next area, types of investors. Right or not? Can I proceed next point or not? Now, next is, I am going to draw something called as utility curve. I am going to draw something called as what? Utility curve. And then I'll complete this investor discussion, then write the notes, and then go for the merging of efficiency frontier and what? Utility curve in the next stage. Everybody following? Now. Can I proceed? Yes or no? No. Next. So, don't get self-pity, so much learning. Always focus hard. I'm again summarizing and before proceeding further. Right or not? Now, let's go to the next stage. Before that, about whom we are discussing? About investors. About what investor? Risk averse investor. How many types are there? Two types. One is what? Conservative, other is aggressive. Both wants what? Risk premium. Both wants what? Risk premium. Conservative wants more risk premium. Advanced, that is aggressive wants what? Less risk premium. The risk premium depends on what? The risk averse factor. Yes or no? Now, you is called as what? The level of happiness. Both me and father may have what? Same level of happiness. Yes or no? But for the level of happiness, by taking this risk, my father wants more return, but I want what? Less return, because my A is what? Less, my father A is what? More. This we have discussed till now. Right or not? Next. Any investor will have more than one utility curve. Will be having what? More than one utility curve. Then only selection is possible. Yes or no? Very simple here. A person wanting to get married, whether it is a boy or girl, they'll have more than one proposals. Yes or no? Proposal from the website, I am saying formal channel. Yes or no? No. They'll be having, for example, Hindus will be having what? More than 5 or 6 horoscopes they'll have, because if one does not click, other may be what happening. No. Always, in marriage also, people have more than one choices and enter into the marriage market. It has become market, yes or no? It enters what? I can understand your feelings. I am saying, okay. Still unmarried. Can I proceed? No. So, it is also a market where I don't go into with one utility, I go with what? Multiple utilities. Yes or no? Very simple, yeah. For example, people may have choices, yeah. First choice, he may want to marry Aishwarya Rai, yes or no? That curve, highest satisfaction, okay. Utility gone, okay. Next, if not Aishwarya Rai, at least one Tamil actor, yes or no? They are also married. Then what happens? Next utility and so on. So, we cannot go into the market with what? One single utility. Go for what? Multiple utilities. Right or not? Now. That's for example, yeah. You should not be taught like that, but still to understand the share market, I'm saying what? About marriage. Okay, now see. This is the next discussion, please. This only will be entering into the next slide along with efficiency frontier. This is the last curve we will discuss about the investor. Are you following? Now, see. An investor can have 3 utility curves. For example, okay, you can even have 4 or 5. Normally, you will be having, suppose, for example, utility curves here, 3 utility curves. Please listen here. Okay. The curve 1 will give him the maximum satisfaction. Curve 2 will be giving what? Next. And curve 3 gives you what? The third level. It's or no. But all the points on the curve, we give the same satisfaction. This is the first observation. Going to be what? First observation. Now, points on different curves give different satisfaction. Yes or no? Now 3 utility cars. Utility 1, utility 2, utility 3. Utility 1 is what? Highest utility, second highest, third highest. For example, you are seeing the pointer here. Okay. Now, if I can find a stock in this curve, another stock in this curve, third stock in this curve. Suppose I am having 3 shares. Okay. One share is having a point lying on the first curve. Second share having a point lying on the second curve. Third share having a point in what? Third curve. Share A, B and C. Which is great for me? A, B or C? A only gives me highest because for the same risk, A gives what? More return compared to B and B gives more return compared to C. Okay. I'll try to find whether any stock is in my first curve that gives me the highest utility. If that is not there, I go for what? Second curve. I go for what? Third curve. So as I go downwards, as I go south in the curve, what happens here? The satisfaction what? Slowly reduces. Yes or no? Very simple. Yeah. This curve is having a which is highest. This curve is having what? A which is second highest. This curve is having what? A. That is third highest. Yes or no? Because A is what I call as our risk averse coefficient. Right or not? Now, so next question is, I have a share security A here. I have a security B here. Tell me which is greater? Security A greater, security B greater. Both are equal. Both are equal because these two securities gives me what? Same level of satisfaction. Still I mean the same utility. The utility is what? Same only. Everybody, are you follow what I am saying? Now to put it otherwise, look at my equation once again. Everything comes only from what? This equation. Can I proceed? Now see. Standard deviation is risk, which is y-axis. Kadaba. Yes, right or not? Now see. Sorry, it is going to be, sorry, x-axis. That's what I meant. It's going to be x-axis. Please, don't disturb me, please. Standard deviation is x-axis, right or not? Now, the happiness which I derive depends on the standard deviation and then what? Expected return. Also what? Adjustment factor. Now, a person having high adjustment factor, will be having what? The lowest level of happiness for a given expected return. Yes or no? And a person having what? Low adjustment factor will be having what? A high level of happiness. Yes or no? If the adjustment factor is very low, then what happens here? I'll derive happiness sooner. Yes or no? By having a less expected return, I can derive happiness. If the adjustment factor is what? Very low. If the adjustment is what? Very high. The same happiness I can derive only by having what? More expected return. Right or not? Now, see, same person will have 3 adjustment factors. 3 adjustment factors, 1, 2 and then what? 3. All points on 1 will give the same happiness U1. All points on 2 will give the same happiness U2. All points on 3 give the same happiness what? U3. Yes or no? No. But for a given return, ER, the happiness will be what? Highest in U1, will be what? Second highest in U2, and third highest in what? U3. Always shares in U1 gives me more happiness than U2. U2 gives more happiness than what? U3. It all depends on my what? Adjustment factor, risk averse factor. Everybody, yes or no? So tell me, what is the equation of this curve? U is equal to what? Expected return minus half into A into sigma square. In this case, A is the highest. When A is highest, to derive the same level of happiness what U2 is having, the return should be more. If the A is high, what happens is, he should also have same happy, he should also have what? Same happy. Then the return should be what? More for that particular curve. Respond. Are you following what I am saying? Like that. Second case, A will be what? Next highest. A will be what? Lowest. And this is going to be the utility curve. Everybody following or not? So this is a utility curve of 2 persons or 1 person or 1 person. He says, I am happy in the first curve. If not first, I am happy in what? Second curve. If not, I am happy in what? Third curve. All points on a given curve gives you what? Same utility or what? Same happiness. Up to this, are you following or not? Next slide I will put and then complete the discussion of Markowitz. Can I proceed or not? Now the last slide. Then we will go for the Tobin of extension of Markowitz. Can I proceed? Now let us complete the next slide with the Markowitz. Now before that, this is called as what curve? Utility curve. Very simple. Now you are there, I am there. Both of us may not be having the same utility curve. We will be having what? Different. For example, this is a person who is willing to take less risk. Risk averse. You want to take what? Less risk. This is a curve. Okay. Now, a person is willing to take more risk. The curve will be like this. Yes or no? This is steeper and this is what? Shallow. Steeper the curve, the slope is more. Slope is what? A. A is called as what? Adjustment factor. Na? If A is more, he is adverse to take what? Risk. He is a risk averse person. Yes or no? Now, this may be U1, U2, U3 for you who may not be willing to take risk. Yes or no? Or not willing to take so much risk. This may be what? U1, U2, U3. A person willing to take risk. Yes or no? To put it simply, my father may be having root curve like this. I may be having a curve like this. These two curves are same or different? Different, because for this the slope is different. For this what? The slope is different because I am having what? This is my curve. This is what? Father's curve. The father is risk averse. He is having a higher slope. So he wants more compensation. Yes or no? This is my father's utility curve. This may be what? My utility curve. Both the slopes are going to be different. Everybody, are you following or not? So this is what we call as a utility curve. So any investor goes into the stock market taking these curves. Taking these what? Curves. Tell me, out of the three curves, which is giving the highest satisfaction? U1. Next highest? U2. Next highest? U3. All securities on the curve gives what? Same satisfaction. I don't worry about investing in A or C if they lie in what? Both the curves. But if the A and C lies in what? Different curves, and always go for the above curve for investing. Yes or no? And my curves and my father curve may not be what I say. My father may be having a steeper curve. I may be having what? A shallow curve, because my A is, for example, risk in neutral person, it will be a straight line like this. All return same only. Yes or no? What I am saying? In the case, less I take the risk, that is less I am willing to have a risk premium, the curve becomes shallow. I want more premium, curve becomes what? A steeper. Either risky person's curve, this is what? A less risky person's curve. Respond. Are you following what I am saying? So this is what we call as the utility curve. Now, the last slide, why we are discussing all this? Only for the last area called as identifying an efficient portfolio. Identifying what? Efficient portfolio. See. Okay. Now, in the stock market, Markowitz have found out the efficiency frontier. Is found out what? Efficiency. This is called as what? Efficiency frontier by Markowitz. Security 3, 4, 5, 6 we have. Number right or not? Yes, now, efficiency frontier is the best available in the market. Yes or no? Yes, which is good? 3 good, 4, 5, 6, all the 4 are good as per the market, because no security is inferior to another. I cannot say 3 is inferior to 4 because 3 has low risk, hence has got what? Low return. I cannot say 6 is inferior to 3 because 6 is having what? More return, hence it is having higher risk. Yes or no? So, from an outsider point of view, all these 4 securities are equally good securities. Or equally what? Good securities, because they lie on the efficiency frontier. Any security below that is bad security. Right or not? No. See. But my problem is I have to select one of them for my investment. Which I should select depends on my utility curve. Depends on my what? Utility curve. Utility curve depends on my risk appetite. Yes or no? My utility curve can be in the top side steeper, or can be what? In the bottom side shallow. Steeper utility curves will be there if I am averse to take risk. Yes or no? And the bottom will be there if I am not willing to take a risk and so on. Can I proceed or not? Now, in that case, let us see what is going to happen. Okay, now, I go into the market with a set of utility curves or not. Now, I put the curve into the market diagram and also put what? The efficiency frontier. First I said, any share in this curve will give me the maximum satisfaction. Now I see, is there any share in the share market which is following the first utility curve? What I do? I reduce my curve. I just want to reduce the curve. Okay. Suppose there is another curve here. Okay. Another curve here. Is there any share in the second curve or not? No. I am just saying another curve here, extra curve. Okay. Like that, keep on reducing the curve. The utility curve first meets the efficiency frontier once, called as point of tangency. This is called as what? Point of tangency. Very simple. Yeah? This is efficiency frontier. This is what? Utility curve. Slowly I see the curve is coming below. It is not touching. When it touches for the first time, it touches twice or once? Once. So that is called as what? Point of tangency. If I reduce the curve below, it will start touching 2 times. Right or not? Right or not? So the first time my utility curve touches what? Efficiency frontier will be at the point of tangency. Yes or no? Now, Then onwards, after U2, I may be having U3, U4, U5, U6. All those cars will touch my efficiency frontier, not once, but what? Twice. Yes or no? U1 does not touch at all. U1, U2 touches what? Once. And U3 touches what? Twice. U4 what? Twice and so on. Everybody yes or no? Now tell me. In the efficiency frontier, in this example, there is this security 3, there is this security 6, and the security what? 5. 3, 4, 5, 3, 4, 5, 3, 4, 5, 6. Okay, now, see, I don't have any security in the market that falls in U1. In U2 security curve, I can find one security in the share market called as what? Portfolio 5. Portfolio 5. Yes or no? In the third, say efficient, that is in the utility curve, I can know how many securities here? 2 securities. One is what? Portfolio 3 and portfolio 6. In my so no, that means have 3 securities that falls in my utility curve. One is what? Portfolio 3. And is what? Portfolio that is portfolio 3, portfolio 5, portfolio 3 and portfolio 6. Right or not? Number. This number is what? Portfolio 3. This is portfolio 5. Sorry, portfolio 5, portfolio 3 and portfolio 6. Right or not? Now. 3, 4, 5. Okay, portfolio 7. I have it as portfolio 7. Okay. Now can I proceed or not? Now. In this case, tell me. 5 or 3 or 7, which is good? Why? It lies on a higher utility curve. Yes or no? So what Markowitz says that where your utility curve runs tangent to what? Efficiency frontier, the point of tangency is what? The optimum portfolio. Yes or no? There can be other points which satisfy utility, that satisfy only utility below you and not what? A highest satisfaction. Yes or no? Now, I like to have the highest satisfaction in U1. Do I get it? Because there is no share in the share market, we are satisfying what? U1. Efficiency frontier is below U1. Yes or no? Now, what I do is I slowly reduce my utility curve one by one, slow and slow and slow, till it touches what? The efficiency frontier for the first time. It touches for the first time. How many times? Once. Called as what? Point of tangency. We are still lower it. It will be touching what? 2 times, etc. I don't want those curves because that gives me a lower utility. Yes or no? So, what is the optimum portfolio? Where the efficiency frontier touches what? Utility curve, the point of tangency. With this Markowitz stops. So Markowitz says this is one should be identifying what? The efficient portfolio. Right or not? This is very important. Now, don't say thank you. Lot of time left. Yeah, can I say? Now, today we have to complete the Markowitz. Okay. With this we have completed the Markowitz theory. Ultimately, what Markowitz teaches you is how to make an investment. How to make an investment. Look at the best in stock market. Look at your preference. Match it to find out the stock market investment. Is the conclusion of the Markowitz theory. Respond yes or no. Now, from here only we develop later a capital allocation line, capital market line. We are very regularly asked examination type of questions. Can I say right down? Let's continue writing the notes. Okay. Now, if I am right, you are copied up to efficiency frontier, right or not? Okay, now, part 2 or part 3, part 1 is efficiency frontier, na? Now, write part 2, please. Shh. Part 2, please. Part 1 is efficiency frontier, right or not? This is part 2, write down part 2. Part 2. Concept of investors utility. Concept of investors utility. Concept of investors utility. Okay. Point number 1. Markowitz now focuses on investors' preferences. Markowitz now focuses on investors' preferences while selecting a portfolio. Markowitz now focuses on investors' preferences while selecting a portfolio. Investors' preferences while selecting a portfolio. Point number 2. Investors can be classified into 3 types. investors can be classified into three types. Investors can be classified into three types. Branch it into three. Risk lovers. Second branch, risk neutral. Third branch, risk averse. Risk lovers, risk neutral, and then risk averse. Okay. AVERSC, risk averse. Go to the first branch, risk lovers, put a down back and right. Put a down back and right. Option 1, right? Option 1, guaranteed rupees 50. You understand only with the help of an example, okay? Option 1, guaranteed rupees 50. Please don't talk. Guaranteed rupees 50. Option 2, a gamble that may give. Option 2, a gamble that may give 100 or 0. Option 2, a gamble that may give 100 or 0 with equal probability. Both has, same branch you write, both has same 50 expected return. Same branch you write, both has. Both now what here? Option 1 guarantee, second is what? Gamble. Both has same 50 expected return. Both has same 50 expected return. A risk lover selects the second. A risk lover selects the second option. A risk lover selects the second option. A risk lover selects the second option. All this I am dictating in first branch. What I dictated here? Risk level guaranteed 50. Our option is what? 100 0 with equal probability. Both gives what? Same expected return. Risk level selects what? The second option. Let's know second option. Yes or no? Now tell me next branch. Risk neutral. Second branch put on my hand, right? Risk neutral. Second branch, right? Risk neutral is indifferent between both the options. 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 Number 8 or not? Next. Risk averse, right? Selects first option. Risk averse, right? Selects first option. Since he does not want to take risk. Selects first option since he does not want to take risk. Can I proceed or not? Now, point number 2 or 3? 3. Point number 3. Risk lover is willing to pay for taking risk. Risk lover is willing to pay for taking risk. Risk lover is willing to pay for taking risk. Due to the utility he derives, he is willing to pay for taking risk due to the utility he derives on account of excitement. Due to the utility he derives on account of excitement. Due to the utility he derives on account of excitement. Everybody following or not? Next. Continue. Risk neutral doesn't consider risk at all. Risk neutral doesn't consider risk at all. risk neutral, doesn't consider risk at all, and always selects the option having high returns, and always selects the option having high returns, and always selects the option having high returns irrespective of risk, and always selects the option having high return irrespective of risk, and always selects option having high return irrespective of risk. Full stop. Continue. Risk averse requires a premium. Risk averse requires a premium for taking the risk. Risk averse requires a premium for taking the risk. Risk averse requires a premium for taking the risk. Everybody are you following what I am saying? Requires a premium for taking the risk. Again I say, if you are risk lover, you receive premium, want to pay premium. You pay money to take the risk. Second person is what? He does not consider risk at all. Anything that gives highest return will be what? Taken. Third person what? If I want to take risk, pay what? Risk premium for me. He asked a premium for taking the risk. Respond yes or no. Write down. Next. Point number 3 or 4? 4. It is proved that almost all investors are, I use the word almost, okay? It is proved that almost all investors are what? Risk averse. It is proved that almost all investors are risk averse and wants more return. All investors are risk averse and want more return for taking more risk. And want more return for taking more risk. Can I proceed? Point number 3 or 4? 5. However, how much risk premium? However, how much risk premium an investor wants? How much risk premium an investor wants for taking a risk? How much risk premium an investor wants for taking a risk depends on the magnitude of his risk aversion. Depends on the magnitude of his risk aversion. Depends on the magnitude of his risk aversion. Next, point number 5 or 6? 6. Broadly, we can classify investors into two types. Broadly, we can classify investors into two types: conservative and aggressive. Broadly, we can classify investors into two types: conservative and aggressive, and can be understood as follows. Please copy this diagram quickly and can be understood as follows. Finish copying, huh? Only our line like this, draw two things. Can I proceed? Continue writing same point. For a given level of risk, or for taking a given level of risk, the conservative investor wants. For taking a given level of risk, the conservative investor wants what return? More return. For taking a given level of risk, the conservative investor wants more return, while an aggressive less return. The reason for the difference is the magnitude of the risk aversion. The reason for their difference is the magnitude of their risk aversion. Everybody following not? Now tell me, who will be having more A? Who will be having more risk aversion factor? Conservative. That is why when the A becomes more and more, I have to have what? More expert, because expert return is equal to utility plus what? Half into aversion into sigma squared. I'll declare formula later. Yes or no? So person having, say, more risk aversion will be asking for more return. Respond yes or no? Now, next, point number 7 or 8? Point number 7, please. Point number 7. The relationship between the utility in bracket write happiness, comma, securities return, we normally call as ER. The word ER means what? Expected. You don't expect extreme, you only expect what? Average. The relation between the utility, happiness, the security return and the security risk. In bracket write standard deviation. The relationship between the happiness, the security return and the security risk is given by the following formula. In one of the ISW examination, they asked a question in this formula. Are you find out now? Then a student don't know where this formula comes in syllabus. Now, but and why it is done. And so all this, again I say it is forming part of a big story. Like this only one can understand without risk. Otherwise, I can do 90 problems in portfolio. Every problem you don't know why we are doing it. Are you find what I'm saying? So we should know in what context, because a CAPM problem will be looking same and the Markowitz looks what? Same. We are able to identify what is CAPM, what is Markowitz. Further only such an elaborate discussion is made. Now, next. Please write the formula. I forgot the formula. U is equal to, everybody U is equal to what? ER minus half into A into sigma square. ER minus half into A into sigma square. Some books write as half into 0.5 that is half, that 0.5 into A into sigma. Both are what? Same. Don't say formula change there. Okay, so half is 0.5. Can I proceed? Now, next. Right, ER is equal to, another formula, ER is equal to what? U plus half into A into sigma square. U plus half into A into sigma square. Can I proceed? Now, point number 7 or 8 or 9? 8. Point number 8, please. Shh. Point number 8. The formula, don't worry about A. Already said what is A in the previous discussion, yes or no? The formula gives us the following conclusions. Point number 9. The formula gives us the following conclusions. So below that, right? The level of happiness the level of happiness is influenced by we know what is happiness here. U is happiness. No, the level of happiness is influenced by the following three factors. The level of happiness is influenced by the following three factors. A. First factor is what? ER, expected return. A, right? Expected return. Put a hyphen under, right? If a portfolio gives more return, in the A actually, right? If a portfolio gives more return, the happiness increases. If the portfolio gives more return, the happiness increases, and vice versa. If the portfolio gives more return, the happiness increases, and vice versa. Respond, yes or no? Next, point B. Point B is what? Risk. In bracket, right? Sigma, standard deviation. Bracket, right? Risk. Bracket, right? Sigma. If a portfolio has more risk, if the portfolio has more risk, happiness increases or decreases? Decreases. Happiness decreases. If the portfolio has, I'll dictate here. If the portfolio has more risk, happiness decreases. If the portfolio has more risk, happiness decreases, and vice versa. If the portfolio has more risk, the happiness decreases, and vice versa. Everybody following or not? Next, point B or C? C. Risk aversion. Risk aversion, right? A. Risk aversion, right? A. If aversion is higher, if the aversion is higher, the unhappiness due to taking risk. If the aversion is higher, that is A is higher. Understand what I am saying? If the aversion is higher, the unhappiness due to taking risk gets magnified. If the aversion is higher, the unhappiness due to taking risk is magnified. The unhappiness due to taking risk is magnified. Because I already said in point B that when I take risk, my happiness what? Reduces. How much my happiness reduces depends on what? How averse I am. If I am more averse, the unhappiness gets what? Magnified. Everybody, yes or no? Unhappiness gets magnified. Now, are you able to understand how the risk is going to be determined or not? Next. Point number 8 or 9 above 9. I think we are discussing all this under what? Okay, now another 3 points I'll complete. Don't worry. Point number 9, please. See, understand that what I am teaching today is 2 chapters in most of the portfolio books. I am teaching you how many chapters here? 2 chapters. First chapter about the efficiency frontier, and second chapter about what? Utility taker, and third chapter about what? Efficient portfolio and capital market line. Are you fine or not? Now, see, I am just condensing what? Chapters and discussing. All these 9 or 10 points are one chapter conclusion, a summary of a chapter. Are you following or not? Now, next. Point number 8 or 9 or 10? Point number 9. An investor generally enters into share market. An investor generally enters into share market with multiple utility curves. An investor generally enters into share market with multiple utility curves. An investor generally enters into share market with multiple utility curves. That is curves giving different level of happiness. That is curves giving different level of happiness. Are you understanding what I am trying to say or not? Curves giving different level of happiness. Curves giving different level of happiness. Respond. Are you following on? Now. So just copy this curve. Same point you continue. Copy the U1, U2 and U3. Finish copying, huh? Draw 3 curves, right? U1, U2, U3, over and not, write down. Continue writing, same point 9. If an investor can find a security, if an investor can find a security in U1, I given the curve name as U1 or not, if an investor can find a security in U1, he will derive the highest happiness. If an investor can find a security in U1, he will derive highest happiness. And in U2, a lower happiness, and in U2 a lower happiness, and in U3 lowest happiness, and in U2 a lower happiness, and U3 it is what? Lowest happiness. U3 is the lowest happiness. Everybody right or not? Now, next. Point number 9 or 10? 10. Different investors have different utility curves. Different investors have different utility curves. A risk-averse investor will have steeper curve. A risk-averse investor will have steeper. Steeper means what? Slope is very much. Okay, a risk-averse investor will be having steeper curve because of higher A. A risk-averse investor will have steeper curve because of higher A compared to an investor who is less risk-averse. 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 Can I proceed on? Now. So, just quickly draw this. This is what? Risk-averse. Next diagram is, this is much more less steeper, na? This is what? Less risk-averse. Risk-averse, less risk-averse. You all know always x-axis is what? Risk, and y-axis is what? Return. Risk and then return. Risk and return. Now, finish copying the two diagrams, huh? I also drawn along with you, yeah? Okay. No time. This is steep, this is what? Shallow, that's all. This is U1, U2, U3 for him. This is what? U1, U2 and U3 for him. Please. Remember. Finish copying on. Don't copy too long. I don't want to show my curve too long in the slide here. Okay, it looks horrible. Can I proceed? No. Shall I proceed? No. Now. 10 points over. Huh? Okay, next give the heading. Part 3 or part 4? Part 3 now. Part 3, efficient portfolio. Part 1 is efficiency frontier and part 2 is what? Investor utility. Now go for what? Part 3, efficient portfolio. Please don't talk. Part 3, efficient portfolio. Copy this diagram before write 4 points in this regard. Okay, with that we complete our discussion here. Okay. Okay, please copy this quickly. Yeah, finished, huh? I'll give you an idea. First draw the utility curve and then draw the efficiency frontier. It becomes very simple. Yeah, correct, huh? Otherwise, it will be finding difficult to find tangency, correct, in a hand. Have you all finished copying, huh? No. Don't take so much time to copy every curve here, please. Please. Shh. Stop talking, please. Shall I proceed? Write down. Point number 1. We are now writing part 3, called as what? Efficient portfolio. Part 1 speaks about market. Part 2 speaks about what? Investor. Part 3 speaks about both together. So now what marriage is going to happen? Yes or no? Part 3 is efficient portfolio. 9 o'clock Muhurtam time. Can I proceed? Now, efficient portfolio. Point number 1. Point number 1. Markowitz now fits the utility curve into the efficiency frontier. Markowitz now fits the utility curve into efficiency frontier. Markowitz now fits the utility curve into efficiency frontier. Utility curve into efficiency frontier. Point number 2. Utility curve represents investor preferences. Utility curve represents investors' preferences, while efficiency frontier represents the best available portfolios. While efficiency frontier represents the best available portfolios in the market. While efficiency frontier represents the best available portfolio in the market. The best available portfolio in the market. Everybody, are you all following or not? Next. Point number 2 or 3? 3. In our discussion, portfolio 3, 4, 5, 6. We add one more thing, 7. Let us have 7 also. Portfolio. We can add one more security. Not an issue. Portfolio 3, 4, 5, 6 and 7 are efficient. Portfolio 3, 4, 5, 6 and 7 are efficient and are equally good. Continue. Out of these, which the investor selects? Out of these, which the investor selects? Out of these, which the investor selects depends on. Out of these, which the investor selects depends on his risk aversion. Depends on his risk aversion, which is represented through the utility curves. It is represented through the utility curves. Point number 2 or 3 or 4? 4. He first searches whether there exists any portfolio. He first searches whether there exists any portfolio that lies in U1. That lies in U1. That gives him maximum happiness. That gives him maximum happiness. If it is not there, If it is not there, he goes for the next utility curve and so on. If it is not there, he goes for next utility curve and so on. Point number 7 or 8, point number 5, sorry, point number 5. The utility curves will first touch the efficiency frontier. The utility curve will first touch the efficiency frontier. The utility curve will first touch the efficiency frontier at the point of what? Tangency. The utility curve first touch the efficiency frontier at the point of tangency, which is called what? Efficient portfolio. Which is called efficient portfolio. All the other points which touches the utility curves, all the other points which touches the utility curves other than the point of tangency, all the other points which touches the utility curves other than the point of tangency will fall in lower utility curves. Will fall in lower utility curves. All the other points, I'm dictating, yeah. You ask me to repeat, I'm repeating. Why you are shouting? Again I say, I'll dictate once again. All the other points, you just listen and write, understand and write. All the other points, which touches what? Utility curves, other than the point of tangency. Written up to this or not? Other than the point of tangency, falls in what? Lower utility curves. Falls in lower utility curves. Falls in lower utility curves. Are you following not? Now, very simple here. What is the point of tangency? Portfolio 5. What is portfolio 5? Apart from portfolio 5, other portfolio falls in utility curve or not? Yes. What are those portfolios here? Portfolio 3, portfolio 7, etc. But why I am not selecting all those points fall in what? Lower utility curves. Respond yes or no. Now, next, last point. Point number 6. The point of tangency, the points of tangency is a portfolio in which the investor should invest. The point of tangency is a portfolio in which the investor should invest. The point of tangency is a portfolio in which the investor should invest. The investor should invest. Everybody, are you following or not? One last conclusion before I leave it. Now, tell me, everybody in the share market, you and me, all of us will select the same efficient portfolio. Because for your utility curve, this may be the tangent. Yes or no? Now, I may be having a shallow curve. I may be having what? A shallow curve where I may be running like this. I can meet it at the lower bound. Yes or no? You may be having a much more steeper curve where this may become what? Point of tangency. Now, for different person, it may be what? Different. That is why all the securities are efficient as per the market. For you, you have to select based on the utility curve. Shh. Wait. That point needs to be dictated. 1 minute. Now, and suppose all your utility curves does not meet the efficiency front at all. No point of tangency. The first curve like this, second curve, third curve. Then what you will do? You don't invest in the share market, put in the post office because for my risk appetite, they are not giving me the expected return. Are you following what I am saying? So, if you are not able to find a point of tangency, if all your curve runs above what? Efficiency, your expectation is too higher than what the market can offer. Don't enter that. Invest in what? Some other avenues. Everybody, are you following or not? Now, last point. Point number 6 or 7 or 8. Point 7. This point of tangency changes from investor to investor. This point of tangency changes from investor to investor. This point of tangency changes from investor to investor depending upon his risk aversion. Depending upon his risk aversion. Depending upon his risk aversion. Bracket la slope of utility curve. Depending upon his risk aversion, in bracket write slope of utility curve. Continue, full stop, continue. If an investor cannot find a point of tangency, if an investor cannot find a point of tangency, it means he cannot derive any utility. It means he cannot derive any utility by investing in the stock market. It means he cannot derive any utility by investing in the stock market. He cannot derive any utility by investing in the stock market. He cannot derive any utility by investing in the stock market. That means he cannot invest in what? Stock market. Ennappa, right or not? No. With this we complete. With this, please, 1 minute here. You have time up to 9:15. This is not right way to behave here. Can I proceed? Now, 1 minute, I'll leave you. Okay. With this, Markowitz completes. But where Markowitz left, a person called as Tobin continued. Okay. Where he developed an area called as capital allocation line and CML. From there, the SML, CAPM gets developed. Are you following up? Now, just a minute, please. Now, today's class little bit heavily loaded because from school days you are used to only do calculations, write numbers. You don't have a patience to listen to explanations. That too, deep explanations. But this is how the current discussion is. I'll summarize and leave it. Please, 1 minute here. Now, just a minute. All of you, for your benefit, close your notebooks. Everything is written in the notebook. You have to go home today and what? Revise. Before you come next class, you have to continue. Okay, please. Shh. Wait. Markowitz took a two-share market, a two-stock security market. No, he took a share market. How many securities here? Two securities. Security A and what? Security B. One is a high return, high risk. Another is what? Low return, low risk. He saw different combinations. From that he said that in a low risk, low return portfolio, if you inject what? High risk, high return security, what happens here? Return will increase, the risk will decrease due to the correlation coefficient. He brought the benefit of diversification that giving the primacy of our portfolio. Yes or no? Now, what happens is the return increases, the risk decreases, so the curve moves leftwards as well as what? Upwards. Yes or no? After some time, those who want to leave may leave now, please. Or stay up to what I summarize and then go. This is not a way. Can I proceed? Now, after some time, the curve makes what? A right turn. The leftmost point on the curve is called as what? The minimum variance portfolio. Why should we catch that point? From that point, the curve continues to become what? Efficiency frontier, right or not? How to find out the minimum variance portfolio? There's a formula for proportion of A, proportion of B. This is for a two security. Yes or no? Markowitz says one can find out the efficiency frontier even for what? N security portfolio using the same logic. Yes or no? From that we got a frontier called as what? Efficiency frontier. All securities or portfolios lying on that are the best in the market. Yes or no? Anything below that are all suboptimal compared to what is lying on the efficiency frontier, right or not? Now, what is efficient security? That security which does not have any other security that gives you a higher return for lower risk, higher return for same return for lower risk. Yes or no? Now, and is there any security above efficiency frontier? No. If there exists, the frontier changes. With this, he completed the efficiency frontier discussion. That means in all these securities, in example 3, 4, 5, 6, 7, in all this, all are equally good. Yes or no? But you will not like all because what you like in the best depends on your risk appetite. Yes or no? So Markowitz changes focus into what? Investor. He has an investor. How many types here? 3 types. The 3 types of investor: risk lovers, risk neutral, and risk averse investor. Yes or no? Risk lover is willing to pay money for excitement generated for what? Risk. Example, horse racing or lottery buying, etc. Are you following what I am saying? And in case of risk neutral, he does not see about risk at all. He only sees return. Whichever highest return will be what? Selected. And risk averse Wants to avoid risk. Wants to what? Avoid risk. If you want him to take risk, he asks for what? A premium. How much risk premium he wants depends on how averse he is for the risk. Yes or no? His aversion is given by an aversion factor called as A. Right or not? Now, the utility he derives by taking a risk is given by the function U. Tell me what the formula for U. U is equal to what? Exponent return plus half into A into sigma squared gives you what? U. The utility can increase, my happiness can increase if a stock gives you more return, if the stock has got a less risk. And if the stock is having more risk, I become unhappy, yes or no? How much unhappy is magnified through what? The adjustment factor. Respond yes or no? Now, Markowitz says almost all the investors are what? Risk averse only. Rarely one can find a risk lover or what? A risk neutral person is what Markowitz says. Now, there are two investors, aggressive, conservative. Aggressive will be having a low risk aversion, conservative will be having what? A high risk aversion. So a conservative investor for taking the same risk asks for more return, for an aggressive asks for a less return. So based on conservative and aggressive, we have utility curves U1, U2 and U3. All points on a given curve gives what? Same level of satisfaction. Points across curves gives you what? Different utilities based on in which curve you are sitting. Higher the curve, more the satisfaction. Lower the curve, less the satisfaction. Take your utility curve, put into what? Share market. See where your curve meets the efficiency frontier for the first time. It means the first time in what? Point of tangency. In that share you should be investing. Yes or no? Other points also it may intersect at a lower cost which gives you lesser level of satisfaction. The point of tangency we call as what? Efficient portfolio. For you and for me it should be same or different? Different. It all depends on our slope of the utility curve. It depends on the risk aversion factor. Yes or no? If your curve does not meet any of the points in efficiency frontier, then you don't have any satisfying investment there. Don't use the stock exchange. Next class, we'll continue with this capital market line and start doing some problems in that regard. Okay.